Good morning.
Not helping out this inflation situation for Europeans at all, John. Again, the headline gas promise halting one more compressor, squeezing flows to Europe.
Europe stuck between a rock and a hard place. Sally, thank you. It's Maria today as well. Bob Michael, Italian 10-year 377, down 40 basis points or so on the day. Do you like that there? Does that make sense to you?
I do, and two things come to mind. The first is central banks think the repricing has gone far enough. They're starting to respond to what they see as stresses in the system. And certainly for the ECB, it's looking at Italian debt. We expect overnight to hear something from the Bank of Japan on their yield curve control targets because the 7-year futures has gotten out of whack with the 10-year yield control. So watch for that. The second thing that jumped out at us is we think the ECB missed an opportunity here. You have an emergency meeting. You're miles behind where you need to be with rates for where inflation is. Why not also raise rates 50 basis points? So announce two things. One, you're going to support Italian debt through whatever your new anti-fragmentation policy is.
All right. Good morning.
Raise 50 basis points because you're behind the curve. And start to front-end load some of that the way the Fed has done it. It's an opportunity miss.
Can you achieve both? Bob, you're an investor in this market.
Oh, without one.
How would you receive that?
I would have received that far better. I would have given a sigh of relief and said, okay, they get it. Last week's news was a mix of not enough and probably a little too much, and there's a chance to go back and fix it. You fixed one, not the other.
Lisa Shannon, equities in the States, that's a tough buy right now and has been all year. Can you talk
Good morning, Robert.
and Europe specifically?
Yeah, I mean, look, we're continuing to try to be constructive here, but we have become more concerned over the last bunch of weeks. As Bob alluded to, that the ECB may be, a little too late. What is it that they say? Never let a good crisis go to waste. And, I think that, especially on today,
All right.
you have the emergency meeting, but you've got Gazprom, the incentives here for Europe to unify behind an anti-fragmentation strategy and really articulate it for the periphery markets, as well as, signal to the EU that now is the time to really articulate a path around fiscal, support. If I were Lagarde, I would be a lot louder and a lot more specific.
And there's some real stress emerging here, and Bob, you've touched on it. And then I look at high yield spreads at about 480-ish, and I'm trying to make sense of it. Bob, a number of months ago, we've been talking over the last few months about opportunities in the market. You like credit, wherever it's trading. Can you run me through how you're thinking about it now, given the changes we've seen, and whether spreads this wide are really that wide at all?
No, they're not. They've held in incredibly well, given what's happened to pretty much all the other markets. If you go back to the March FOMC.
All right. Alibaba is higher this morning. It's up 2%.
About 500, so they're actually still tighter. If you look at investment grade credit, spreads are about 115 basis points. You go back to March, they were 155 basis points. So
Looking for Chinese stocks to continue.
Everyone's comfortable.
Steel index, ETF, SLX is higher this morning. SLX. That's currently bouncing. SLX. All right, Baba.
If you're in equity, you go up the capital structure into high yield, and we're seeing some of that occur.
So let's talk about it. You get a final word. If you're a buyer here, where are you a buyer?
So we're chasing alpha here. The beta or the market index trade, we think still is vulnerable, and a lot of that has to do with valuations. And as we've talked about many times, the market cap skews.
Chewy looks pretty good. Chewy.
There's stocks to be bought.
All right, we got 7 minutes to go for the opening bell.
But an outright economic recession that we still don't see fully on the horizon over the next 12 months. So where is that? That's in some of the industrials, some of the financial names, some of the home builders now, biotech. Those are all trading at recession.
All right, retail sales coming in month over month, actual minus 0.3%, forecasting plus 0.1%, and previous was 0.90%.
We're doing that too. So just so you know, we've been buying credit as well.
Elisa, Bob's just trying to make markets. That's what he uses my programs for. Don't worry about it. Lisa, Shannon, Bob, Michael, Bob. You're naughty. Coming up.
All right. Let's get ready for the opening bell. All right, Chewy looks pretty good. Daily, hourly. Chewy looks pretty good. I'm watching this one potentially. Okay, SPY is up $3.49. SPY's up $3.49. All right, let's get ready for the opening bell. We've got 3 minutes to go. Hope everyone had a good evening. All right, I'm going to stop the screen here. I'm going to switch screens. Okay. All right, first 15 minutes, I don't do much of anything except take profits off the table. First 15 to 20 minutes. You know, if you've been around for a while, we look for algos to take care of imbalances that first 15, 20 minutes. So we don't really get a true depiction of what institutions are doing, it's at least as far as the indices are concerned, until after about 9:50 at the earliest. 10 o'clock's better. Reason being, VWAP matures at around 10 o'clock. We can get an idea if we're going to get a flat day, upsloping or downsloping VWAP. It's very important. Watching relative volume to see what institutions are trading and watching their tier 1 or tier 2 upgrades or some event on a stock or asset to put it in play. And that's usually followed by relative volume being greater than 2 to 1. After 10 o'clock, I start looking at most actives. And there you go. We're open. All right, look for profits. Markets are moving higher. All right, Alibaba with a nice gap up this morning.
Extreme high tick alert. High tick alert plus 800.
All right, give the markets a few minutes to settle down. Good morning. All right, Baba fading a little bit, looking for a bounce. VIX. VIX, this is not updating. Let's see, Pendudu. All right, Baba, SPY, and VIX. That's not the right price.
Extreme high tick alert.
VIX is down. All right, so VIX is not updating at the moment. Let me just do this, see if we can get this to update. Go to 5 minutes. 2 minutes. All right, now it's starting to update. Okay, cool. Little quirk with stock charts. Okay, SPY up. Holding at the moment. Okay, Alibaba starting to bounce. NVIDIA is higher. Okay, something very important. Okay, over the next couple of days, we're probably going to see a bounce. It's not guaranteed, but if the Fed does 75 basis points,
Extreme high tick alert.
the belief is that people that I've been talking to, the belief is that we might get a rally into Friday. Okay, so we're looking for that. This rally, very important, is something I'll be taking more risk off because the quote unquote experts I've been talking to, friends over at UBS and other places, have been telling me that liquidity is drying up. Let me show you what liquidity looks like right now. Liquidity. Let's see if I can display this. The book dip in the equity markets
Extreme high tick alert.
is narrowing quite a bit. Let's see. Let me go back a year. The book depth in the S&P 500 futures. Let me go back a year. The book depth, you can see, come on, 2020. You can see the liquidity, how far it's dropped off. Okay, this is important because if you're trading thinking the markets are going to rally back up to all-time highs again, think twice. That's all I can say. I'll be keeping my hedges on for this reason, one reason, and looking for reasons to sell into strength to reduce my risk and position even more so
High tick alert plus 800.
for anticipated downside. A lot of these people I was talking to yesterday over at UBS, can't mention names, are looking at 3,600 as the next level. A bounce after the Fed, a bounce, a rally, short-term rally, and a move lower to 3,600. So we'll be looking for evidence. Number one, do more puts show up or do more calls show up on the S&P 500? So that's what I'm watching. Pretty simple. If it doesn't materialize, I'll update you. But for now, liquidity is a big problem. Okay, and you should be aware of it. I'll be selling into strength, continuing to increase my hedges. All right, so the FANG stocks are all bouncing here, giving you an opportunity maybe to exit some positions. Roadblocks on the move here. Roadblocks. Let me keep an eye on our Pinduoduo is starting to bounce here. Watch these bounces in the Chinese stocks. RBLX, Roblox. Nice move on Roblox. Roblox on the move. Veru on the move.
High tick alert plus 800.
Redbox looks like it might want to change directions here. Redbox, watch Redbox. And Roblox, RDBX. All right, we're starting to bounce. SPY following through into FOMC. SoFi on the move, pushing higher. IWM's higher. Most actives on the New York Stock Exchange. Tupperware. That's an interesting chart. Carvana starting to bounce. Tesla on the move, despite what sensationalism on these autopilot or whatever it is, this news this morning. Tesla's moving higher. Nucor gapping up. Boeing, Moderna follow through. Moderna, Align, ALGN, Etsy bouncing. Tapestry, and Boston Scientific. Okay, that looks good. S&P, that's the Dow. Here's the Dow. Boeing, Intel bounce, gap up. Not very big bounces here. Looks like shorts covering. Microsoft.
Times, Macron, Scholz, and Draghi are planning a joint trip to Ukraine.
Cisco. All right, so everything looks good there. Still early. Almost 9:40. Alibaba looking for the bounce. VIX is at the low. And we're just waiting.
We have just posted the Financial Times article regarding Macron, Scholz, and Draghi expected in Kiev to support Ukraine. That is available on the feed.
Just waiting for the markets to settle down. All right, NVIDIA, more puts on NVIDIA showing up. Amazon, puts and calls, Amazon. Tesla, Target. Stocks are being bought. Tick cumulative is green. Internals bullish.
Plus 800.
Internals are green. Excuse me. Tick cumulative is green. Internals bullish. So far, it looks like a lot of short covering. All right, so now we need to see a follow through over the next 30 minutes or so. So the initial pop here, we got a lot of stocks moving higher. Okay, give you an opportunity to exit a few things. SPY is still trying to push through. All right, so resistance today. Resistance 3,800 and 3,850. Support is at 3,755 on the S&P 500. SPY 375, then 3,700 below that. Our SPY is starting to move higher now. Chewy looking pretty good here. Need to see a bounce. All right, red
Extreme high tick alert.
Roblox. Tesla continuation. Target. At Carnival, I was seeing some bullish divergence noted on Trady Ticks. Watching Carnival and the airlines, cruise lines. All right, there goes SPY, continuation. SPY. Still going.
Extreme high tick alert.
SPY. Let's see what SPY looks like. SPY. Yeah, this could fade. This could fade. Bookmap is running into, we're seeing resistance overhead, supply 3790. Above that, just shy of 3800. We've got a lot of supply between here and there over the next 10 handles. So if you didn't buy the low on the dip right there the first few minutes, You're running into supply now. We could fade a bit now. Most likely will. Watching SPY right here. VIX still rolling over though. With the expiration today. All right, SPY is starting to fade now. We're running right into supply. If VIX starts to spike, it'd be a good area to maybe have some short-term puts. Right now, I'm not doing anything. I'm just waiting to see what happens. Algo is taking care of imbalances. First 15 minutes. So this could very well reverse or just shoot to the highs. 380 is a major level, and 3,800 on both the futures and the S&P 500. Amazon pushing a bit higher. Cleveland Cliffs with a nice little bounce here. Cleveland Cliffs after being off yesterday. Bonds, the 20-year bond is pushing higher. The steel ETF SLX, Sierra Lima X-Ray, SLX, the steel ETF bouncing. Google's up 43. Google's up 43 points. Communication sector seeing some strength.
High took alert plus 800.
All right, so more follow through on SPY. 380 is the level. Let's see, aggressive buyers all morning. I still got a lot of supply at 3,800. I don't think we're going to make it through this level at the first shot anyway. Then there's another level at 3,820. That would be a hoot. And 3,830, 3,835. Okay, SPY just sitting here trying to push through these levels.
UK government says it is disappointed
Red box looks like it's trying to turn the corner.
proceedings relating to grace periods currently in place.
Watch red box here is trading at 1092. Red box RDBX.
UK government says proposals set out by the EU today are the same proposals we have been discussing for months and will not solve the problems.
All right, approaching the opening range. 10 o'clock opening range. 9:30 to 10 o'clock opening range. VIX is still dropping off. SPY looks like it wants to keep going. All right, so we are running into some
UK
supply.
government says the EU continues to insist it is unwilling to change the protocol itself, so we are obliged to act ourselves to change the parts of the protocol that are causing problems. This stream is sponsored by TickStrike. TickStrike.
Yeah. Okay, we know. All right. SPY. All right, so far we're chewing through supply at the highs of the day. All right, looking for SPY. What's it going to do? All right, we're right in supply. Very narrow band on bookmap. Supply above, demand below. Very narrow band of about 10 handles. So mostly short covering this morning. SPY, not seeing confirmation on this move higher. SPY, not seeing confirmation on this move higher. Listening for high ticks, extreme high ticks or low ticks, extreme low ticks, listening. GTX, GTX. Let me take a look at GTX. That's the most active, GTX. Gapping up. Garrett Motion. What do they do? Let me check GTX. Garrett Motion manufactures and sells turbocharger and electric boosting technologies for OEMs and aftermarket. GTX. Oh, interesting. GTX. GTX. Let me see what that looks like. GTX. Currently on buy signals. Relative volume 2.14. SPY still struggling to get through this supply zone. Futures as well. Acadia Pharmaceuticals. What's Acadia doing? Acadia Pharmaceuticals, ACAD. ACAD. Acadia. This one looks pretty good. Watching Acadia Pharmaceuticals. All right, SPY still running into resistance supply. Acadia Pharmaceuticals. Okay, that's one. Chewy fired a TTM squeeze this morning. FYI. Chewy. Looks good on the 5-minute, 15-minute, 60-minute for now. Chewy and ACAD. Chewy. Watching SPY pulling back here. Chewy active.
At 10 a.m. Eastern Time, we are expecting the US NAHB Housing Market Index, forecast 67, previous 69. We are also expecting US business inventories month-over-month, forecast 1.2%, previous 2%.
Chewy, watching Chewy here. Let's look at Chewy on the daily. All right, Chewy looks like it's going to bounce. Let's see, Chewy. Daily's above 0, but not yet on a buy signal. 60 minutes on a buy signal. Chewy, just watching it for now. And the 15-minute, Chewy. Everything is pretty much
High took alert plus 800.
all right. Watching supply here, futures, book map. Supply building, it's about 50, 60, 75,000 contracts overhead, 75,000 in supply. Up volume, pretty decent so far. Got to get through a lot of supply here.
Seeing from a Bloomberg report on Twitter saying the Biden administration is planning on more funding for military weapons and equipment for Ukraine. New tranche to be more than $650 million.
All right, so just watching Chewy. Chewy's starting to pull back a little bit. Get a better entry if you wait at the present time. Wait on Baba, looking for a little bounce in Baba. Red box looks like it wants to keep going. RDBX, RDBX.
German network regulator says we are impacted with further reduction in supplies via Nord Stream pipeline.
Red box, nice little
Biden
pop
administration's new tranche of
and drop.
support for Ukraine is to include vehicle-mounted Harpoon anti-ship missiles. German network regulator says supplies continue to be secure.
Red box continuation. Red box. Nice bounce. Watch red box for a bounce here. All right, we got a lot of supply in this area, futures. So it pays to just wait a few minutes and see if we can get through this 3,800 level. Deltas are positive on the futures, so I'm not saying that we're going to pull back. If we can get through this supply, we've got about 50, 60, 70, 80, 90,000 contracts overhead to deal with. All right, looks like we might fade.
Seconds. 67, 67, in line with the forecast of 67 for the US NAHB housing market index. US business inventories month over
NAHB,
month at 1.2%,
housing
1.2%.
in line.
So just to recap there, that the US NAHB housing market index came out at 67 in line with the forecast of 67.
Red box is
Well,
going.
the US business inventory is currently coming out right now. It came out at 1.2%, also in line with the forecast of 1.2%.
Red box potential scalp.
US
50
business
cents.
Inventory is current prior revised at 2.4%.
Red box watching for a follow through. All right, looks like we're going to keep going. All right, so if we can get through 3,800, this is the key level. We haven't gotten through. We got 9 handles to go. Futures have 9 handles to go. Tesla, nice turn on Tesla. Tesla following through. Looking good. Target's up 2. Dollar Tree's up 4 pennies. It's flat on the day. All right, looks like we might push through it. We got to get above 3,800. All right. Still a lot of supply there. It's not backing off. If you're watching Bookmap, you can see all of those contracts. Gets through 3,800. Deltas are rising now. Aggressive buyers. Okay, I'm just sitting here watching futures among everything else. Chewy's still going. Chewy looks good. Chewy looks good for the follow through. Chewy, Cocoa Pop. Chewy. Yeah, Chewy looks good. Chewy's on a buy signal. 5 minute, 15 minute, 60 minute. Red box looks like it wants to go. Watch red box. Okay, SPY.
High took alert plus 800.
All right, currently have a strangle on the markets. I have a 375 put that expires today and a 380 call. Might just keep the 375s on. If we hit 380, we're probably trying to get through. So whatever direction we choose to go. All right, looks like we're starting to move higher. Can we get through this supply? If we do break higher, I'll take the puts off and let the calls run. If we start to drop off, I'll sell the calls. Maybe buy them back later on a dip. Chewy's still looking good though. Chewy looks good. Red box flagging. Red box looks good on all time frames. Chewy. Okay, Chewy's still moving. Chewy. Red box pulling back a little bit. Chewy looks good. Do we have any options on Chewy? Let's see what we got here. Chewy. No hurry. There's no hurry. Make sure you check everything. Chewy. Chewy, there's calls. That's about it. Small. Where's the size? 98 contracts. That's not much. Chewy. All right, looks like I'm going to keep going here. I'm going to get rid of these puts here shortly. Maybe buying back later at the high of the day. Got to get through 3,800. Pretty formidable resistance for now, but deltas continue to rise. So the pressure is against the bears with the bulls for now.
Around 1 billion of artillery and anti-ship missiles, as well as other weaponry for Ukraine.
Come on, let's go. Let's go, SPY. All right, I'm out of the puts for now. All right, got to get through this level. Still a lot of contracts here. Chewy continuation. Okay, VIX, keep dropping off, VIX. Seeing calls on Apple, Meta, Facebook. Calls on Apple, Meta, the FANG stocks, basically. All right, got a nice follow through. Chewy's still going. Chewy, let's see what Chewy looks like on the ATR. Chewy has an ATR of $2.40. It's currently up $1.88. All right, running up against resistance. I'm already up what I lost on the puts. So I'm at break even right now. Still a chance for this to reverse because there's so much supply right here. There's about 70,000 contracts just waiting to sell, trying to sell at this level. All right. All right, VIX is trying to turn now. Chewy has $2.40 in ATR. It's currently up $1.88. If it gets above this volume by price band, we could see a little move towards the 50-day. 50-day, 2 points overhead. Chewy is currently trading 29.93. All right, sector-wise, all sectors are green currently, except for crude oil and energy. All right, looks like we're going to back off a little bit more. All right, we're starting to back off now. SPY. All right, SPY pulling back some more. Looks like the supply is too much. Deltas are dropping pretty fast here. Deltas are dropping pretty fast. Still SPY's hanging in there. All right, so presently we got 3,800 as a major level on the futures. I'd like to see us above 3,800. Then we could run up to higher levels, 38.35, 38.50. Many of the people I've been talking to recently, friends. All right, here goes SPY. I've been talking about liquidity and a potential rally between now and OPEX on Friday, but are looking for lower prices in the coming weeks. SPY, do we go? All right, so it all depends if we get above 3,800, 3,805. Watch the futures here. Got to get above 3,800, 3,805. All right, we're just sitting here at supply. Are they getting ready to drop this or not? If we drop through a VWAP, it could be the case. Deltas are dropping. Okay, we've got all sectors except energy are green. All right, semiconductors day 2, strength. All right, we're just sitting here. I feel on a helium balloon, hovering. Chewy, still looking pretty decent here. Chewy. Red box consolidating. Veru. Chewy. Dollar Tree. Target pushing higher. Tesla fading. All right, more selling coming in. Are sitting near VWAP right now. SPY. Sitting near VWAP. All right, Microsoft. Goldman Sachs. We're going to get a bank rally. Looks like shorts covering. That's all I would consider this right now. Disney. Okay, you draw a trend line through these lows along here. 1 back in January, 2 in May, 3 the recent pivot. You've got a descending pattern. Possibility you could get up to the 9, 21, or 50 day and get rejected. The last time we were rejected was a little push over 21. Got a feeling Disney might continue lower. Why? Because a lot of these stocks in this group, hospitality, whatever, Vegas is starting to bounce. Elvis is starting to bounce. Let's see if these can improve a bit. I do note the positive divergence on WIN, bullish divergence on RSI. WIN. Hilton Hotels.
Just a heads up at 10:30 a.m. Eastern Time. We are
Starting to
expecting
bounce.
USD
Hyatt.
crude oil inventories Forecast -2.2 million.
Host hotels.
2.025 million.
All right,
USDIA
Delta.
inventories
All these starting to
forecast
bounce.
-0.5
Delta.
million. Previous 2.592 million. USDIA gasoline inventories forecast 0.5 million. Previous -0.812 million.
ARC after a dip yesterday bouncing.
Green index sitting at 7 out of 100, indicating extreme fear.
There's 375 puts are working. Slow. The silver index, the steel index, SLX is high.
Sponsored by To The Tick. Get free daily pivot points, Fibonacci, and market profile levels by signing up at tothetick.com.
Target's just on a tear. Target's on a tear. All right, puts are working. There's a lot of supply overhead. A lot of supply. Okay, so far it looks like we've got a higher high, and we're watching this low printing right here on SPY. Dow Jones. Penn Gaming, another gaming stock related name. Looking for the Chinese stocks to continue higher. Baba just consolidating. VWAP, right along VWAP, you can see the highs and the lows on Alibaba. Keep an eye on option flow on Alibaba. I'd like to maybe add to the 110 calls for next week. Chewy, looking for a bounce. VIX is trying to turn the corner. All right, UVIX. You know what? I wanted to roll those out, those calls out. Yeah, I can roll those out now. Okay. Roll them out.
Seeing the fear and greed index out at 18 out of 100, indicating extreme fear.
Can roll them out for a credit. Wow, those come in quite a bit. All right, SPY starting to bounce. SPY starting to bounce here.
At 10:30 a.m. Eastern Time, we are expecting the US EIA crude oil inventories forecast -2.2 million, previous 2.025 million. US EIA distillate inventories forecast -0.5 million, previous 2.592 million. US EIA gasoline inventories previous forecast 0.5 million, previous -0.812 million.
All right, so the markets are just hovering here, so let's see what we can do. Should
Also,
we?
just having a look at the highest estimated and lowest estimated forecast for US EIA crude oil inventories, highest being 3.2 million, lowest being -4 million.
SPY at VWAP, trying to hold on to VWAP here. A lot of stocks ran up the first 15 to 30 minutes.
Also, just
And
looking at yesterday's release, the US API crude oil stock change release that came
all right,
out.
SPY backing
the
off
actual
some
came
more.
out at 0.736 million, 0.736 million, compared to the forecast of -1.2 million.
Baba's still pulling back a bit. All right, AERC. That's looking a little better. AERC looking a little better today. Up 64 cents after dipping yesterday. AeroClean. All right, waiting on the markets to give us a clear signal. SPY trying to hold this level. All right, SPY trying to bounce.
Germany's energy minister Habeck says Russian side's justification for cutting pipeline gas flows is a pretext. One minute to go now, I'll be reading the US EIA crude oil inventories first. Habeck says it is a strategy to sow uncertainty and raise prices.
Chewy trying to negotiate the highs of the day here. Chewy.
Germany's energy minister Habeck says we can get necessary quantities from the market, albeit at high prices.
All right, the semiconductors continue to look pretty strong. Semis.
Habeck just repeating that supply is secure. Ten seconds.
Chewy at the highs. SPY trying to continue higher. Printing a lower high for now.
101.956 million, 1.956 million. To build on the forecast of -2.2 million. US EIA gasoline inventories -0.71 million. -0.71 million. That's a draw on the forecast of 0.5 million. US EIA distillate inventory 0.725 million. 0.725 million. That's a build on the forecast of -0.5 million.
All right, so seeing IBB popping a little bit on the 2-minute chart. You got to move potentially back to 110, then 114-ish. IBB, XBI, bouncing. LABU, bouncing a little bit on the double bottom. Maybe we get back to 8 short term. Let's see. Let's take a look at VIX. VIX starting to turn the corner. All right, so SPY puts are working. Futures continue to pull back. Let's see. Book map. Yeah, supply too much at 3,800. Maybe we get above it after the Fed. All right, so I was talking to some friends last night. A couple of them work at UBS in the city and some others on the West Coast that are talking about liquidity drying up. I showed you the liquidity this morning. This is the CME liquidity. S&P futures book depth. Let's see what the 10-year looks like. Futures. Wow. 10-year note dropping off. Liquidity dropping off. Also talking about their thoughts with inflation for today into Friday, talking about inflation and the Fed, that if we do see the Fed raise what's already expected, 75, then we could see a relief rally because all of the hedging that's been going on around this event, that event risk will taper off in the short term. So we're looking for a bounce that we can sell into because they feel, the majority feels like 3,600's in the cards. Now, I will look for evidence, meaning puts need to tell us. Like coming into this week, we saw 370, 3,700 was a major level. And we need to see more calls. It's pretty simple. We just need to see what institutions are doing. We got the JP Morgan collar expiring the end of the month. So a lot of things going on, and liquidity is drying up. Credit risk, credit spreads, the bid-ask for credit spreads are widening. While it's not as bad as what we saw back in 2020, February, March, there is a interest rate component that's presently not showing up in those spreads. All right, so watching SPY here, we could rally. SPY starting to rally.
The US EIA weekly inventory report is available on the feed for those interested in reading.
All right. Just watching SPY here, looking like a bear flag, maybe. Not a lot of volume. Not a lot of active trades to speak of at the moment. Watching Chewy, Alibaba, the Chinese stocks. Let's go take a look at the Chinese stocks real quick. They appear to be taking a break today after a nice rally. Okay, all of these are up. QTT is a penny stock. EDU following through. Follow through day on EDU. That's looking good. More downside potentially. Watching a bear flag on SPY.
US crude inventories in the SPR drops to the lowest level since January 1987. Also, ahead of the FOMC rate decision, we have just provided a prep document for those who would like to read along to that.
All right, still dropping off here. SPY put side is working. VIX is turning ever so slightly. VIX. Let's take a look at EDU. All right, so it's consolidating. Look at VWAP starting to flatten out. So if you've got EDU still from Monday or from last week, a number of you mentioned EDU. Okay, breaking, obviously changing trend. All right, the weekly is above the 10 EMA for the second week. Actually, the third week. Looking for EDU to continue higher. For much the same reason, I'm looking for Alibaba to continue. All right, SPY. Not going anywhere. It's also possible we just sit here and do nothing between now and the Fed. AERC trying to go. Supply is dissipating. Futures. All right, supply is dissipating very noticeably, as are the contract sizes trading. But 3,800, 3,785 up to 3,800 still pretty noticeably. All right, SPY, we're going to drop off here or what? We got a 15 handle range between the low and the high as far as supply and demand. 37.85 supply, 37.72 is demand zone or support. Looks like we're going to keep dropping a bit more. SPY. Stocks are just chopping around here, not going anywhere. Alibaba. All right, so Chinese stocks.
This stream is sponsored by TickStrike.
All right, EDU. Just consolidating along a flat VWAP. All right, we've seen in the past on Wednesdays that we see a lot of theta killing where it doesn't go anywhere. Markets don't go anywhere. We do have VIX expiration, monthly expiration out of the way. So that was a lot to do with the drop in VIX, among other things. And we got FOMC. Everyone's basically figured in 75, a rate of a hike of 75. And I imagine most people are expecting another 75 a couple of times during the summer. One of the reasons why my buddies at UBS and others that I've been talking to are expecting lower levels. Some are even expecting 3,000. Let's see what that looks like on the S&P. 3,000. So very important that you don't get too wrapped up in what people on StockTwits are saying, but watch what price is doing, and yields especially. At S&P, this is not very bullish looking. We could see a pretty quick rally, but I don't think we're getting above 4,000. Everything is setting up. We're certainly not going back to all-time highs. So if you're expecting all-time highs, I would quell that expectation. All right, so the first line is right there. Volume by price. That's still there. So we've got to wait until 2 o'clock. I would think realistically we'll see after 2:30, 3 o'clock what the markets really intend to do. RSI is below 50. We got resistance right there. Currently from the pivot that we put in first week of June, we're down 11%. I think the risk to your portfolios in the short and intermediate term, the risk to your portfolios, especially if you're a 401k or IRA, you're thinking about retirement, whatever. I think the bigger risk is that having too much risk on the table while the Fed negotiates the reverse of what they did since 2008, 2009. Okay, they lowered interest rates to induce stocks to rally, among other things. And now they're doing the opposite. All right, they're taking liquidity from the markets. They want the exact opposite you should expect the exact opposite of what the easing did from 2009 into the current levels. So until I see evidence otherwise, that's what I'm anticipating. All right, I don't need both of these. To be safe, the risk is that you assume that the markets are going to just rally back to the highs unabated. I don't think that's going to be the case. So I've been since March 29th, I've been actively reducing risk. You know that. I'm down to 45%. I need to get it down to, I would like to get it down to 40%. So I'm looking for another rally like we had the end of May into resistance. I'm looking for another rally to de-risk a little bit more, take a bit more off the table. And continue to hold on to my hedges. I currently have QID. I have UVIX. You know about UVIX. That's the 2 times the VIX asset class instrument. I have RWM for short on the Russell. Now, if we start to blow past last week's highs, that's another story. Then, the signal obviously would tell me to get more bullish. But you got the 50-day is rapidly descending into that area where we were just 2 weeks ago. For 8 trading days, we just stuck there between 4,100 and 4,175. Now the 50-day is moving down and below that level that we traded last week. That's important to acknowledge. People saying, oh, that everything is so ugly, we got to bounce. Yeah, we're probably going to bounce after the Fed. I would think we probably bounce as the event risk dissipates. But for the longer term, I'm reducing my risk and hedging. I'll stick with those hedges until I see a reason why. All right, there goes SPY. SPY dropping off here.
800.
All right, SPY dropping off.
Extreme low tick alert.
Okay. So we're dropping off pretty fast here. So if you took the 375 puts, you're probably pretty happy. SPY pulling back. SPY pulling back. VIX hasn't started cooking yet, so we could see that moving much higher. Not a lot of blocks, very few blocks on the SPY. All right, down to the lows here. Now we're going to get a rally. Now we're going to get a rally. Yeah, the supply has dissipated quite a bit now. Hardly any supply overhead now. Hardly any supply overhead on the futures. VIX just chopping around. I don't see a whole lot of blocks, so it looks like institutions are just on the sidelines right now. I think that's pretty important. That makes sense when you think about it. Why would they want to put a lot of risk on right now going into the Fed? Stocks are starting to bounce. Good. Yes. All right, let's keep an eye on TQQQ for Anna. Keeping an eye on TQQQ. TQQQ looking for a follow through. There goes Chewy. Yes, exactly. Exactly. Captain Cautious. Exactly. Markets, the Fed can't spook the markets right now. Okay. The Fed needs to let the markets rally into a bit into OPEX. Fed can't crash the markets. Now, you might disagree with me, but that's the consensus that we came up with as well. The Fed, um, you notice that the Fed governors weren't speaking that much recently. I don't know if they were blacked out from talking or whatever, but um, everybody's expecting 75. Everybody's expecting 75. And the Fed needs to walk this tightrope very cautiously without falling off because of the market. There goes Baba. There goes Baba. Baba going. Might add next Friday 110 calls. Yeah, exactly. The Fed officials have been talking less frequently over the last few days. I believe they've been blacked out. I don't know. I can't confirm that, but that was the consensus. And because the markets have seen a lot of selling, a lot of freaked out people selling at the lows. Again, I'm just speculating. I don't know what the hell is going to happen. You know, nobody knows what's going to happen. But if they come out a little more dovish, if they come out a little bit more dovish, um, you know, the Fed wants to do the opposite of what we did back in 2009, 2008. So much liquidity, and you can see that. You can see that starting to change. Okay. Our Cashin was talking about liquidity. Okay. Everybody knows about it. So you should be aware of it too. Okay, you can check out this tool at the CME group. Okay, if you look at the liquidity, the book depth is very important. This has been tapering off as the markets have been had this high back here in January. How we've been tapering off. Notice what the liquidity is doing. It's compressing. All right, SPY no follow through yet. So what we're looking for is liquidity to pick up. I don't think that's going to be the case. I think they keep as their reverse repo kicks in. We'll know for sure today that, and my terminology might be a bit off, so don't give me a hard time about that. But the sense is the Fed wants to ease the markets back, a soft landing, if you will. So they're having to do a very precise address to what markets are doing at the present time, and let us off a little easier. If they come out with a point hike, the markets are going to crash. I just got to have a feeling. That's why I'm keeping my hedges on just in case. And a few minutes ago on the dip, UVIX, I rolled up for a credit. I rolled up to the 18 strike for September. We could see UVIX blast way past where we are presently. And VIX could see 40s again. I'm telling you the worst case in the short term. Worst case is that we could see the VIX bolt higher. Okay, let's take a look at VIX real quick. So you can't stick your head in the sand. You got to be aware what's going on. Your fellow members in the trading room, most of you are on the right side of this thought process that we could see more downside. I don't want to go here. I want to go to VIX. All right, we spiked up again. VIX, the speed of the volatility of VIX. Looking for that to come back in. Looking for a little rally into Friday. All I'm looking for is another dead cat bounce like we had 3 weeks ago into a week ago. We had a nice 2-week rally. That's all I'm looking for. VIX VXV. We're up there at extremes again. That generally leads to a bounce. You can see this getting steeper and steeper. The Fed comes in and heavy hands the markets. I think, oh, you don't see what I'm looking at here. Hold on a second. Hold on a second. Okay. You don't see what I'm doing right now. I realize that. So just give me a second. Just got to update this chart. Okay. So we're up here in the extremes. Doesn't mean we can't move lower, but I don't think the Fed's going to crash the markets today. I think they may be just saying, you know, we're in line for what we're looking for, blah, blah, blah. 75 basis points, 75 on the hike. That's what the markets are looking for. What it's already figured in, watching UVIX climb. VIX is starting to climb a little bit more. We could see a lot more of this choppiness into the Fed. That's what I'm thinking. The SPY blocks are telling us there's not a whole lot going on. Not a lot of trading by institutions. We've got futures. We're seeing bookmap with deltas are just moving sideways. We're in a tight range between 37.60 supply and demand, 37.85, 37.60. So about a 20 handle range, low to high, where the major demand below or support is around 37.60, 37.65, and overhead 37.80. 37.80 is supply. So if we can jump above 37.80, we might get a little rally into the Fed, maybe 12 o'clock or so. That's where I would take some profits off if you have calls or you're long, and then wait for the announcement, see how the markets react. That's my plan. Amazon continues to rally a bit more. Okay, all right, so we're coming back now.
Low tick alert minus 800.
Coming back. So a pretty dramatic sell-off here. We were above the zero line on the NYHL, and you saw those 150 to 1 down volume on Monday. All right, let's look at NYMO. NYMO and breadth. All right, breadth is at extremes, but it is reversing. So that's telling me maybe a quick bounce back towards the mean reversion. That's all I'm looking for. Dead cat bounce, mean reversion. We got a peak in NYMO and NAMO. So that's mirroring everything we're seeing. A peak. So we got a long way to go for a trough. So we could base here as well. In a nutshell, in 2 sentences or less, in a nutshell, I'm saying de-risk and hedge. And if you have to trade, small size and day trades. Okay, so for now, that's all I'm doing. Okay, de-risk, take risk off, hedge, and day trades. That's it. Swings are kind of off the table. If you do swing, I do have some BABA calls for next week. Chewy's still going. I might hold on to Chewy for the rest of the day. We'll see how Chewy works. Chewy's still going. Chewy has a $2.40 ATR still going. Chewy's at the high of the day. Continuation. Nice bullish candle. $2.43, 44 cents. All right, so we're getting close to its ATR for the day. Could have an expansion day. We have pressure, so I'm not expecting it to blast higher. But above this level, looks like above 29.25. Above that level will be in 29.25. We'll be in the Kirby here above this red line. You can see over here there's very little volume. It's traded above the 50-day all the way up to 42. Looks like 42 even. Okay, man, put another line there, 42. Okay, you can see that Kirby line overhead, that ceiling. So once price gets into this area, we could see a nice follow through. Volume. Chewy still pushing today. All right, still pushing lower, SPY. All right, so we have less volume to deal with supply-wise. If we can get through here in the 50-day, we could see a move up to 42. Not the best day to try to look for swings. So I'm more interested in day trades. So if this does continue to move higher, Chewy, I'd like to see a test of the 50-day. All right, VIX still grinding higher. Chewy and a few names are moving higher as well. AERC is near the highs of the day. AERC. All right, SPY. Sorry about that. All right, the markets aren't moving much anyway. We get a little push to the high, a little push to the low.
This stream is sponsored by Tick Strike.
Give me a break. All right, Chewy still going. Alibaba, nice follow through. Alibaba. I'd really like to add to Alibaba. Alibaba's going here. Baba going. All right, Baba's going a bit more here. Alibaba. There goes red box, RDBX, ticking higher. Chewy. Chewy moving higher. VIPS. Let's see. Baozun. Baozun high of the day. All right, HYG moving a bit higher. SPY dropping a little bit here. TQQQ looks like a range. You can see the flat VWAP today. TQQQ. Looking for a little bounce back to 27 or 29, the 9 and 21 day EMAs. Chewy still grinding higher. Chewy still grinding higher. Red box moving higher. All right, so red box is still going here. Red box. Flat VWAP, so the most I would expect is a move back up to this high at 1198 that we saw just before 1010. 1008, we hit that high. Red box. Alibaba trying to break higher. Chewy just grinding along. TQQQ, flat VWAP, looking for a pushback to the upper Bollinger Band around 2450. Supply dissipating. Futures. We got pretty thin resistance overhead if we do bounce. I just don't see any reason for the markets to just rip higher until after the Fed. Maybe we'll get a little short covering rally. It's probably going to be boring until about 2 o'clock, 2:30. If we get any kind of rally, if you feel like taking a walk, take your cell phone with you, take a walk, ride your bike, go play some golf, go hit some at the driving range, or go jump in the pool. Just keep me live, and I'll update you if there's any changes. But it feels like we're just going to drift here listlessly. Supply dissipating. Go jog. Do something for your health. Okay. Chewy, Tanny. All right, so you've got high relative volume on Chewy, so you could sell some covered calls, I guess. High implied volatility. Chewy, July 30 calls are going for almost 250. Twitter, a little bounce on Twitter. Choppy action on Twitter. Looking for a red box to do something here. Alibaba trying to take out this morning's high at 107. 107 was the high of the day for Alibaba. Shape shifting lizards are running the world, according to some people on StockTwits. Shape shifting lizards. Alibaba trying to go. All right, so what's trading today? Let's see. All right, more calls being talked about on Devon Energy. Okay, let's look at Devon for a minute. Devon off a bit. Our markets are just not going anywhere real fast, right? Alibaba trying to push higher. Okay, let's go take a look at the most actives again. Moderna, top of the list. Most active, plus almost 7%. WBD, what is that? WBD, Warner Brothers Discovery. WBD turning. Penn Gaming, Penn. Penn Gaming, Netflix. Netflix. A lot of questionable names out there. People still looking for more downside. CMG, Chipotle. Can't believe this is a burrito company that trades at $12.50. CMG. Trading 42 times. Trading 42 times adjusted operating earnings. With PEG at 22 times normal, usually 22 times. We're trading 42 times on Chipotle. Just can't wrap my head around that. That's quite a premium. No major activity. Targets high of the day. TGG, TGT. Target high of the day. All right, CMG, I just can't see it. It's too expensive. Tapestry, night bounce on Tapestry. Okay, retail, specialty retail. Dow Jones, Boeing, Goldman Sachs, Microsoft, CRM. Higher lows, but not much juice in some of these charts. You can see. Look at American Express for an example. You know, we just continue to make lower lows and lower highs. Any kind of bounce is probably going to get rejected somewhere between 150 and 154. Target still going. Target. Nice bullish engulfing candle, engulfing the body of yesterday's candle. I know some of you like to use the wick. I aspire to Tom Bukowski's method. He looks at the body of the candle. Regardless, we got a nice bullish day. 7 points on ATR. Target. All right, it's up 5. Everything is pushing higher for the most part. Nvidia, Microsoft, Meta. Can't wrap my head around Meta. Tesla just grinding above VWAP. Apple above VWAP. Okay. Target though. Target looks pretty good. Target's at the high of the day. Day trades working well. Target looks really good. Look at that VWAP. Look at how price accelerates away from VWAP. That's institutions. Pretty obvious that's institutions buying. Okay. So currently you can see the 20 EMA on the 60 minutes, rather flat. We're moving above it now. So target needs to get above that red line there. This is a 60-minute time frame, but that's the 20 EMA as a reference point. That's a reference point. That's 20 EMA on the daily overhead at 162.50. So we've got quite a rally to get to that point on target. See if we can't change trend. Right now, all I'm anticipating with target is a base continuing to form here. So maybe we get back up to 151 or 165. Redbox had a nice rally and then it dropped yesterday. Looks like momentum traders are back in this one again. A little bit of selling at 12, but it looks like it's trying to take back 13 or this gap 14 up to 18. Redbox watching that one while the markets are not entertaining us very much. Stocks like Redbox looks like it might do something. The most that I would expect is be that 12 level. You got a flat VWAP. So we'll probably jockey back and forth between 12 and 1060. Maybe it runs higher. Very interesting. Jets is starting to see a little bit of buying here. Jets, flat VWAP. Airlines got whacked the last few days, starting to bounce. 3-candle reversal on Jets. Riot has been in the dirt lately. Riot. A downtrend with Bitcoin. A lot of talk about Bitcoin and some of the larger holders if they have to liquidate. US dollar, Bitcoin US dollar. That's pretty ugly. Remember when it was 60,000 and change? Wow. There goes SPY. SPY starting to move now. SPY starting to move. Got a flat VWAP. So the most I would look for, you got the low now. Look for the high. Maybe you get back to 380. Walmart trying to turn. Walmart turning off the low. Same here with Walmart. Just looking at base. I'm just looking at this basing. Chopping around here for another couple of weeks while institutions accumulate shares or not. Looking for more volume. TQQQ. All right, trying to bounce here. All right, let's see some people talking about AbbVie 155 calls. AbbVie 155 calls. Nah, I'm not going to trade that. Okay, Tesla, more calls on Apple, more calls on HYG, high yield corporate debt. Some puts on Amazon. That's probably Russell. Tesla, more puts on Tesla as we reach the highs. Some put flow coming through. HYG with some put flow. Target's still going. Stocks are moving up and to the right. Most of my charts are up and to the right. FANG stocks are seeing market heat map. They're green. Everything is green. Moderna, more calls on Moderna coming through. Moderna, mRNA. Moderna, let's see if there's any size there. Moderna, 500. 500 of the 170 calls for, was that January? This is flying by. Moderna, where'd you go? The 170s for August. 170s for August. Got about 600 calls there. Contracts trading on Moderna. Let me just go to Moderna real quick. mRNA. Moderna, pretty active today. Pretty active today, Moderna. $130s all the way up to 170. Most active on Moderna are for Friday, for this Friday. All right, so it's probably going to be more of this kind of action into the Fed. So in through noon, I expect price action to do pretty much what it's been doing so far today. Alibaba continues to push higher. Apple, Nvidia, Microsoft, Tesla, Amazon, and Facebook, Meta, up and to the right for the most part. Alibaba needs to get above 107. That's where most of the action is on Alibaba. Okay, Alibaba's got some nice action so far today. Tesla's still going. Tesla's chugging higher. Red box pulling back a little bit. Alibaba. TQQQ. Chewy. Baba. Tesla. Let's see. Tesla. So still pushing higher. Tesla needs to get above that 685 level from this morning. Tesla. Tesla. What are you doing, Tesla? Tesla. Tough day. Tough day for a follow through. Stocks are acting like institutions aren't the ones trading. Looks like just momentum traders and the general participants, you and I. Tesla up against its gap resistance. Tesla. Tesla's got a gap over there. Baba still pushing a bit more. 107 is the high of the morning. What's gold doing? Gold last week looked pretty good. Coming into this week, nice gap up on gold, GLD, but still basing. GLD, gold still basing. All right, so the Qs, we got one block at 1,300,000. And that was 280.93. 280.93. All right, the Qs, we got one block at 280.93. That's 1,360,000. We're below that level right now, so we need to get back above basically that 10 o'clock, 10:15, 10:05 pivot. That's a 10:05, 10:10 pivot. We got to R2 and got rejected. So if you're thinking bullish, we need to see that. Plus, we need to see VIX drop off a bit more. All right. Microsoft fading a little bit. So is Tesla. A little profit taking there. Target at the high of the day, starting to see some consolidation going into lunchtime. Target. All right, it's probably going to get really slow. Probably slows down quite a bit in the next couple hours, folks. So if you're looking for a time to break, it's a good time. Roblox still rising. Roblox. Roblox new high today imminent. Let's see. Do we have volume on Roblox? I thought we did. Roblox. Yeah, there's Roblox. Roblox is trading 2 times relative volume. Roblox trading 2 times relative volume. Let's see what Roblox looks like. RBLX, Roblox. A nice little bounce there. Trying to break higher. Roblox. Resistance overhead. All right, Q's starting to push a bit higher now. Q's need to get above that block at 280.93. All right, we got another 60 cents to go. Alibaba trying to go for the high. Roblox. All right, so you can see what's going on with Roblox. You got supply overhead. Chewy. Baba. Tesla, TQQQ, looking for a little break above this pivot right here at 24.39. We're starting to push through that area. Qs are starting to push a bit higher now. NASDAQ 100 Qs trying to push a bit higher now. All right, most stocks are moving up and to the right. Dollar Tree dipped a little bit. Chewy dipping a little bit. Dawn, that one was active recently. Dawn, D-A-W-N, that rings a bell. Let me go check that out. Tesla looks okay. D-A-W-N, Dawn. A1 Pharmaceuticals, currently flagging on the 60-minute. Tesla still driving higher. Alibaba looks like it wants to go. Alibaba. All right, so TQQQ moving higher. Grind. All right, what are some of these biotechs doing? Moderna having a decent day. Moderna started off the week. We're following through now, 130. Probably gets rejected at 140. All right, SPY and the Q is continuing higher. Target fading at the high of the day, 148.50. Fading 55 cents. TQQQ breaking higher now. VIX dropping off quite dramatically there. We've got NASDAQ with 4.8 to 1 up volume. NYSE is 3.6 up volume. Tick cumulative is trying to turn the corner valiantly. TQQQ still going. All right, let's look at that. TQQQ. Versing QQQ. QID. Okay, so the most I'm thinking is that after the Fed, hopefully the Fed doesn't stomp on the markets. I really don't think Jay Powell is going to do that. I don't know. I don't have a crystal ball, but I suspect we could see a bounce back towards the 10 EMA weekly. And then I'd be interested in adding to hedges and shorts. I don't think we're revisiting anything above 315 on the Qs in the short term. Think being the operative word. Knowing that the Fed wants to do the exact opposite of what they wanted to do in 2007, 2008, which was inflate the stock market. Now they want to do the opposite. So, I mean, they're pretty clear about what they want to do. All you have to do is participate in the conversations in the trading room after the bell, when the room gets pretty active in their discussion. It's been pretty good. Been pretty good stuff. I peek in every once in a while. Chewy fading. All right, stocks are starting to fade a little bit from the highs. Maybe take a little profits off going into lunch. Don't want to buy the high of the day. Clovis on the move. Clovis is moving higher. All right, Clovis is a penny stock. There's a penny stock. Some people were mentioning it yesterday. I believe Frank mentioned it. I don't like trading penny stocks. I mean, I'll do it for fun every once in a while. Moderna, much like stocks like Moderna that have a lot of weight behind it on the follow through today. Resistance overhead. Algo flow on Tesla's been pretty good today. Tesla's still going. Alibaba at the highs. Needs to get above 107. And we need to see more calls coming across. I really don't see a reason to buy anything between now and the window, the 2 o'clock window, when the Jay Powell announces, the Fed announces their rate hike. Everybody knows they're going to be a rate hike. TQQQ looks like it wants to keep going. Any strength here going into 2 o'clock, if you continue to push higher, right around 2 o'clock, I'd probably take a little bit of profit off if you're long from the lows. All right, the Q has made a low around 278.80 and have rallied 2 points off the low, about 1% off the low. So if we continue to follow through and we get above, say, 281, 281.50 into the Fed, 282, something like that, and you're long, I believe Anna's long TQQQ, probably take a little profits in there and watch what happens after the Fed. Probably won't have a good idea of direction until after Jay Powell speaks. He'll start around 2:30 and finish up hopefully by 3. Though he probably is going to get a lot of questions today. Hopefully the algos don't go nuts over his use of words. He's usually pretty measured in his approach during the Q&A. Probably. Implied volatility should come in a little bit, I would think.
Years. It's been 15, 17 years since I've been able to credibly tell clients, yeah, you should invest in bonds without saying that you're going to lose your purchasing power. You are, right? But it gives stability to the portfolio. Now, look, we need to get to more normal interest rates. We should get to more normal interest rates. The point I would make in this discussion is there is room for the Fed to do this. By that, I mean, if you look at the economy, Scott, which obviously you do, you see that the ISM surveys
10-year yield.
see where jobless claims are. I know you're going to say, well, wait, these are lagging indicators. That's true. However, jobless claims are extraordinarily low. Put another way, the ratio of job openings to unemployed people is 2 to 1.
will be
It's huge. There is room for the Fed to get this done. I'm not saying it's a slam dunk, that it's a soft landing. It's not a slam dunk. It's a hard feat to pull off. But what I am saying, and Steve's kind of said this, I've listened to you, Steve, on other shows too. You know, Steve said, yeah, it can be done. It can be done as the answer. So we haven't heard from John Nigerian, who I really want to hear about. John, because you look at shorter term things in the market a little more closely than others do. Kevin suggests that the market is going to, I think he said, rip if the Fed does 75 today. What does your experience and what you're seeing today tell you? If it does rip today, they're going to rip it up tomorrow, Scott. That's what I think. That's what you've seen time and time again. If the market reaction is extremely positive and you see a 500-point face ripper rally, then I would say you're going to see negative for Wednesday, Thursday, and Friday. And I'd say you talked about zooming in, Scott. Let's zoom out just a little bit. So I agree.
There goes Alibaba.
A 4% rate that Steve just mentioned is tolerable, and we can rally. And to Mr. Wonderful's point, if we've got 9% returns in the market, yeah, 4% is fine. But I think that during these 15 years, you've been goosing this pretty good with really low interest rates. So most of the gains here have been with those low interest rates. They haven't been with significantly higher interest rates. And so I'm not as certain as the rest of many of my colleagues that we can just go right back to, oh, it's only 4%, and gee, it was 16% in 81. That's not really what we're looking at here. Again, you zoom out, and you see a market that really will not tolerate, in the short term, in short term, I'll say 3 to 6 months, Scott, will not tolerate significantly higher rates. And we heard from Ford today that delinquencies are up. We're going to hear it from GM. We're going to hear it from everybody on credit cards, on mortgages, and that's before the 75 basis points kicks in. After that, that's where we really have the risk that the Fed drives us to a recession, which I say is a 70-30 proposition at this point.
Well, I need to know from you, Joe, where do
A
you
lot of
think
conviction there.
I mean, I don't care 10
All right,
minutes.
Alibaba gets above 107, folks. We could go here.
Ahead. We put new lows in this week after some suggested that the lows were already in. So the market's fragile. It's going to hear from the Fed chair, who may be more hawkish than he was in the past. Remember, the reason the market initially ripped is because the way he answered Leisman's question about 75 being back, being off the table, in not so many words, but that's the way the market took it.
So my sense is, as we move towards the end of this quarter and the mid-year halfway point, I think unless today he goes beyond the 75 basis points, if he puts the market, as I said before, on notice that potentially he could hike rates in between meetings, he has to do something beyond that. If he doesn't, there's too much negative momentum, there's too much negative sentiment to reverse, and that leads me to believe through the remainder of the month we're very vulnerable to return to the pre-pandemic highs at 33.93.
Leisman, I mean, really, game it for me. What are the chances that he's going to lay the groundwork today for an intra-meeting move? I'd say that's near zero.
I don't think he needs to do that, Scott. I think what he'll do is, guys, I have a chart in the back there real quickly that I put together about how.
There goes Tesla.
It's called Fed funds pricing, I believe it's called. And here's what the market is priced for right now: 275s, 250s November, and then a 25 for December. That's
There goes Tesla.
275 basis points of tightening for the full year, getting you to 365, and then you need to get to 4 to fulfill the where the market is priced right now, sometime in May of next year. I think, obviously, Scott, what I want to know from this meeting from Powell today is, does he affirm the way the market is priced right now? I'm afraid that
Amazon, high of the day.
The answer that I want, and I think the people around this table want, which is, where are you going with this? How high do you need to go to get inflation under control? And I think the answer is that this is meeting to meeting. And so when you ask me what stocks will do, I know it sounds like a bit of a cop-out, but I think volatility is probably the best call here, in part because I don't think the Fed is sure about what it's going to take to get where it needs to go, which is getting inflation under control.
Yeah, Jim.
Square.
Jeffrey Gundlach.
All right, there goes Baba. Baba's trying to break out here.
That's the kind of stuff that he suggests is needed. And as all of you, I hope know by now, I'll speak with Jeffrey in overtime today in an exclusive right after the Fed. So we'll get to react in real time.
Amazon going some more.
What the Fed did and what it said, and he's always provocative.
Alibaba.
His tweet last night suggesting just get to 3% tomorrow.
All right, we're getting a rip here.
That's what he said last night. So we're going to get his instant reaction. But, people want more. Yeah. Kramer wants more. Gundlach wants more. Ackman wants more. O'Leary wants more.
And Jimmy wants more. Joe wants more.
The farmer wants more.
There's a reason why. Because when we get to the other side of this rate hike cycle, which will peak at some point, okay? I don't know if it's 3 or 4%, but let's say it's 4%. When you
Market's back to R2.
You've got some really good things to look forward to.
There go the Qs. All right, we're back to R2 resistance.
After effects of the pandemic. There's a long
NIMO.
after effect of the pandemic, which is really powerful. And it's supply chains moving out of China, moving out of Russia, moving out of hostile countries, back here to the U.S. and to the greater North American region, also to the European region. Those are powerful economic forces that are going to keep people employed, that are going to have us constructing things, building middle-class incomes again. That Ross Perot in the 90s came up with the idea, the great sucking sound of jobs going overseas. They're coming back, all right? And that's a positive thing to look forard to. It's not going to get upended by 4% on the Fed funds rate.
So,
all right?
It's not.
So, Leisman, let me. You have a last word?
Shut up, Leisman.
Yeah, I just feel like
God, he really bugs me.
Deglobalization is bad for the stock market, bad for the economy. We had 1.7 billion Chinese workers working for us, and now we want to cut that off, and we don't have enough workers to do half of the things Jim wants to do. God bless his ideas on it. We don't have the workers here if we don't have immigration, and if we
What?
deglobalize.
We don't have the workers here in the U.S.? What the hell's wrong with Leisman?
Thank you.
Just one point to my colleague Steve. We always look. We always have respectful conversations, but if we're worried about layoffs at Carvana, at Peloton, at all of these companies, let's keep them employed in better and more productive for the economy jobs.
Yeah, but you speak about it, Jim, as if this is happening in 10 minutes after we get beyond the Fed doing its thing or on the other side.
If I spoke that way, I apologize. I was trying to say this is 2023 and beyond. Let's get past.
That's not going to happen in 2023. You're not onshoring everything in 2023.
You absolutely are doing it right now. Are you paying attention to what
You're talking about like wholesale changes in the economy that are going to happen in 6 months? No way. No.
Listen, Scott.
No way.
The announcements are all out there.
No
You
way.
got a new rare earth element mine announced yesterday. You got semiconductor plants going up.
So the economy is going to be completely transformed in the next 6 months, ladies and gentlemen.
That is not what I'm saying, and you know that. And I'll repeat what I said yesterday, that this is a multi-year phenomenon. It's a long-term after effect. You're going to feel it in 2023 and in the 2 years.
Leisman, I know you got to bounce. Let me let you go, but I'll see you this afternoon. I know that. That's Steve Leisman. We'll all see him later. Here's the issue, Kevin O'Leary. I come back to you for this idea that the market's going to rip and stocks will be fine and the second half's going to be great. If I asked you what the earnings are going to be, you have no idea. You can't tell me that.
So I have to take a view on it. You're not giving enough credit to the productivity that's come into this market over the last 3 years of all of this technology that drove direct-to-consumer businesses, enhanced margins dramatically, gave us a whole lot of new tech. Let's use Nike, for example. During the pandemic, they went from 38% direct-to-consumer to over half, 55% direct-to-consumer, at an 80% gross margin. You're not giving them any credit for that? What about all the other companies? What about all the private companies that have done that? No credit for that? This is a more productive, higher gross margin economy, and nobody wants to give it any credit. You're all wrong. What's going to happen is we're going to have fantastic earnings, much better than being brought down right now in Q4. I get jump ball in Q1. Maybe Steve's right at 4%. I am nowhere near as negative as everybody else around the table right now. Too much good stuff has happened, and nobody wants to give credit to it.
Kevin, I hope you're hearing me, man. I don't know where everybody around the table is sounding negative.
I mean, fantastic earnings in Q4. You're an outlier thinking that.
I'm just saying they'll be better than what is being drawn down right now. People are so negative. They're saying, and show me where this recession is. Show me in the employment numbers. Show me in the sales numbers of private companies. Show me where is this recession. Bring it out. I don't see it anywhere.
Alibaba about to break 107.
Let me ask you the critical question. The pricing of oil is obscuring everything that you're talking about. How do you resolve the challenge we have right now in the price of oil? That's the economy, the market. It's not going to be able to recover unless we see some relief, and relief that we can believe is a long-term solution for oil.
Here's how you fix that problem. It was a policy mistake by Biden when he came in. You reverse the mistake. All you have to do is job vote. The oil market's a futures market. Just announced you're going to license 3 new refineries on the East Coast. Also announced we're going to re-examine the XL pipeline. We're going to give back the leases in Anwar. We're going to give more carbon direction to understand what the costs are. All of those policy mistakes could be reversed by just getting up and job voting it. You could take oil down below $100 if you got more accommodative towards the future production. Yeah. Now, Biden may not do that. That's on him, and he'll pay dearly for that.
I have a bridge. I know this bridge that goes from Manhattan into Brooklyn. Yep. I can sell it to you for a hefty fee.
Oh, what an ass.
Doc, let's do this. Let's take a quick break. We have Tom Lee on the other side from Fundstrat. We're going to work him into this conversation, into the mashup, where he thinks everything's headed. We'll do it next.
All right, so nice look so far today. Nice look so far. Cool. So, yeah, looks good. Looks good. All right, nice rally into the Fed. I'd be taking profits off into strength. Amazon still going. Holy smokes. Amazon is burning rubber here. Okay. Look at the volume just like shut off there.
Less than 2 hours until the
There
final
goes
statement on
Baba.
interest rates. Let's bring in our headliner. He is Tom Lee. He's managing partner and head of research at Fundstrat. He is a bull on the market. I think it's fair to say you still are. So do you think we're getting 75 basis points today? And how will the market react?
I think markets have already priced in 75 if you look at interest rate futures. So I would
Tell
say
him,
that
Tom.
makes a lot of sense because the Fed doesn't necessarily want to surprise markets. And I think that I'd agree with those who say that a move like today is probably better for risk assets, only because it really narrows the perception about how far the Fed is behind. You know, a simple way to look at it is the spread between the 2-year and Fed funds, which Jeff Gunlock has mentioned many times. And it's at the highest level since May 94 today. But after the hike, this brings it down to levels that were actually lower than we were around April this year. So I think in some ways, you know, investors could actually start to feel better that the Fed isn't as behind, fewer sort of upside surprises. And of course, the data has to start cooperating going forward.
But they're going to be really aggressive going forward. Don't you agree with that? You saw Fed funds futures, what Leisman was talking about, where rates could really be going. The market's just going to be just fine in that scenario. I think people have a hard time believing that it is.
Yeah, there's I would say that nobody can say the macros is super clear right now. I think it's been helpful to see some of the slowing and the job cuts because that just shows the current hikes and the current tight financial conditions are slowing the economy. And I think, of course, the unknown is what happens with gasoline because that is really driving people's perceptions about CPI. But on the flip side, I'd agree with what Kevin and Jim have been saying. You know, there's a real test happening to corporate America here. You know, in the pandemic, people expected earnings to collapse, but companies slashed costs and managed through that well. And I think that really earned them a view that they're
Alibaba rejected at the high of the day for now. Some people taking profits.
Assuming that companies are going to get massacred in this current environment, but if they're going to navigate through this better than expected and earnings hold up better.
All right, Alibaba looking for it to get above 107.
The Fed isn't necessarily going to shock
Alibaba.
surprises. So even if rates, you know, if the Fed hikes from here, a lot of that's already priced into future interest rates. So there's fewer surprises to discount rate and what you think risk premia should do. And so I think stocks could do a lot better.
John and Jerry, and I want your counterpoint, I suppose, because you're extremely negative, it sounds to me, against what is Farmer Jim and Kevin O'Leary and Tom Lee's optimism.
Yeah, I mean, I'm an optimistic guy overall, Scott, but I'm also.
So am I. I'm also realistic.
I'd love to hear Tom's opinion on. Tom, you heard today that Ford had significantly higher delinquencies. Granted, that's coming from a low rate. I get it. But that's only going to be accelerating for the next year. That's going to go over to credit card debt. It's going to go over to mortgages. We all know how this snowballs. So how can I be as optimistic as you, Tom, if I know that consumers that are 70% of the economy are going to be strapped? They're not going to be able to trade, as far as there'll be more people renting because home affordability is going to be going down. Meeting that mortgage payment is going to be a lot tougher unless Biden actually did something about an energy policy, which he has only done a negative energy policy so far. I mean, you already said the price that will be paid to transport items for people. I mean, increasing interest rates doesn't bring food prices down, doesn't bring gasoline prices down. It just doesn't. You can impact other things,
Right.
But those two will not be brought down because people have to eat and they've got to get somewhere.
Strapped consumer, right? If not now, it's coming.
Yeah, this is sort of the peculiar, that would be peculiarly positive actually for equities, John. And it's not because I want people to lose jobs and not repay their loans. These are obviously, bad signs, but in the aggregate, it actually has two effects. One is it's really going to slow the perception about inflation, because if you've got delinquencies and repossessions and housing slowing, well, that just kills two stalwarts of the inflation narrative. One is housing and owner's equivalent rent in the future, and second is goods pricing. And it also weakens the job market. And as you know, the Fed is really concerned about how tight the job market is. So I think if what's happening on the margin actually supports the idea of a soft landing. And if it's a soft landing, the Fed doesn't have to go as far. That's a very minority view right now, because I think people are really concerned about inflation. But it's even if you look at things like the Cleveland Inflation Tracker, core inflation is cooling, not maybe fast enough for the Fed, but there are signs of cooling. And if we add all these things, it means core inflation could drift lower. And that's probably the best news for risk assets.
I mean, and they're not only worried about inflation as to why they think there's not going to be a soft landing. It's because history suggests that the Fed can't pull it off. And maybe that's the overwhelming factor in the reason why there is a level of pessimism that the Fed can do what the market suggests.
All right, Alibaba breaking higher.
Funds futures, and then somehow they're also going to have the incredible ability to avoid a recession. We will see. And Tom, I know we'll talk to you multiple times in the weeks and months ahead. I got to run. I'm tight on time, but we'll see what happens this afternoon. We'll see you soon. Coming up, we do have many moves from the investment committee to get to today. Their latest buys and sells are coming up next.
Okay, making nice progress today so far. Nice progress into lunchtime. Tesla's still pushing higher, trying to get up to 700. Alibaba's above 107. I felt that if we get above 107, we'd see more buying, more calls. Looking for more calls. Baba. Okay, Q's still pushing higher.
Hello, everybody. I'm Contessa Brewer. Here's our CNBC News update this hour. Federal prosecutors are filing hate crime charges against the white gunman who allegedly killed 10 people in a racist attack at a Buffalo supermarket. The 18-year-old suspected shooter is facing 26 counts of hate crimes and firearms offenses, which carry the potential of the death penalty. Attorney General Merrick Garland is in Buffalo today and expected to address those federal charges. A water main break in West Texas could leave more than 160,000 residents in and around Odessa with little to no water for the next 2 days. Look, this is a big deal. The county's declaring a state of disaster because there's a massive heat wave with temperatures reaching triple digits. Texas Governor Greg Abbott is directing state agencies to help coordinate the response as there's an imminent threat of severe damage and loss of life. His words. Former Atlanta Mayor Keisha Lance Bottoms will join President Joe Biden's administration. She will replace Cedric Richmond as director of the White House Office of Public Engagement. The senior staff role is responsible for bridging the gap between the administration and the American people. Break here. We'll be right back.
All right, Alibaba still holding up very strong. All right, Q's getting rejected now. Q's. Alibaba high of the day. All right, we got an hour and a half to go. A little less than an hour and a half to go. All right, so I'm just watching. We're making higher highs, higher lows. Would expect to see a little bit of profit taking going into this time period. Between now and 2 o'clock, I would expect to see some profit taking. Not a complete sell-off, but a little profit taking. AERC, nice pop there. AERC.
We're less than 90 minutes now away until the Fed's decision on interest rates. Let's get the CEO's view now. Joining us now is Tom Rogers. He's the CEO of Target Media, the executive chairman of Engine Gaming and Media, back here for the first time in a couple of years, and one of the founders of this great place. It's good to see you.
Great to be here, Scott. Well, nobody does Socratic method on television better than you do. It's terrific. I feel like I'm back in law school when I watch you.
I really appreciate that. I try, but it's so good to have you. Really, I do want the CEO's perspective, right? Ahead of what is a incredibly consequential Fed meeting. What's the fallout? What are your views?
Well, whether it's 75 or 50, I'm not here to predict. But I think overall things are going to get worse before they get better. And I think for legacy media, which we'll discuss in a little bit, they're going to get much worse before they get
AERC on the move.
Of the economy. I know you have friends in all sorts of places, CEOs who are running other businesses. Does this feel like recession is imminent to you?
Well, certainly people are preparing for a recession. And sometimes that could be self-fulfilling. You're certainly seeing the job cutbacks. You're seeing discretionary expenses cut back. You're seeing travel, which has already been cut back because of the pandemic, being cut back even more. So certainly people are preparing for that eventuality, and the preparation itself can be self-fulfilling.
Let's get into your wheelhouse if we could, because this is in many ways the year of a handful of stocks that have been of the biggest of stories, and Netflix is among them. Stock was like $700, and it's been destroyed. And some are questioning whether Netflix's best days are behind it. What's your view?
Well, my view is the market has overreacted with respect to Netflix and streaming in general, to the downside, and underreacted in terms of the downside potential of legacy media. And I think what will be clear is Netflix is still the leader in the streaming world, will continue to be. There are some 500 million cable and satellite subscribers around the world who are still linear television viewers who, unless you think something abruptly is going to change and people are going to stop being attracted to all good programming,
Baba pulling back.
Media, a lot of them are going to be
50 cents from the high. Stocks are seeing a little bit of profit taking. People quick to take profits today.
Like you say people are preparing for. You have many more competitors on the landscape than you used to have. It's a different world. Well, Netflix today than it was yesterday.
It is a different world, but you got to look at it also from what's going to happen to legacy media. They're going to be hit with a quintuple whammy here. You already have cord cutting, the $100 bundle continuing to go down. Inflationary pressures are going to cause that to accelerate. You have lower ratings. With lower ratings, you have lower advertising. With impending recession, you have a big advertising pullback. And on top of the advertising pullback, what you have is a reallocation of money from top of the funnel, so-called brand advertising, to performance advertising, which favors the digital crowd. So all that's going to hit. What you have with streaming,
Tesla looking for a higher low.
The inflationary impact on Netflix and the streaming industry generally, the bundle is going to get hit worse. $100 is where you're going to save the money. You're going to pick up some streaming services in return. Moreover, what we've seen on cable and satellite in other recessions is people pull back on out-of-home entertainment spending and rely more on in-home entertainment spending. The prevailing in-home entertainment today is streaming media, and so they're also going to be able to benefit some from more focus on in-home versus out-of-home entertainment.
Well, I feel like legacy media has been declared dead like 1,000 times, and that death has been greatly exaggerated over the last handful of years, notwithstanding some of the obvious metrics that people are seeing, that you're suggesting are only going to get a lot worse, but maybe it's not as bad ultimately as you suggest that it might be.
Well, that's a fair point. Certainly, when we were at NBC, a broadcast-only network, and people said broadcasters were dead, and we made a transition to cable, and you are here today to see how successful that transition was.
Futures need to get above 37.90 supply.
Transitioning to a far better model than the cable model. Cable and satellite model, best model known to man. Maybe only 20-25% of households ever watch a network, but you get paid across 100% of them. When you're moving into streaming,
All right, SPY, more pullback here.
into a much worse business model. You got to get paid only across those homes that will watch you and pay for you and stick with you when it's much easier to churn, much tougher model.
See, now this gentleman sitting to your right would suggest that Netflix's problems are a Netflix problem, and that he owns Paramount, for example. example, and I'll let you opine
Yeah,
on why you own
minus
Paramount
800.
relative to that, but that's the argument you make. It's not in everybody's problem with competition and lack of subs and declining subs, et cetera, et cetera. It is a Netflix problem, has its own problem, and then you have your Paramount.
Yeah, and thank you. I mean, it's exactly the question I want to ask you, which is there are certain industries in which all the companies move in lockstep, right? I mean, oil and gas, whatever's going on with fossil fuel and macroeconomics, all those companies move together. Certainly, we're seeing in some of the results a differentiation, and I'm just curious.
All right, Bob, I'll pull him back a bit.
The broadcast industry is going to have companies all move in lockstep or not, and if they are going to differentiate themselves, boy, I'd love it if you'd give a pick or two. And I know we're part of the parent company here is Comcast, so we've got to give a nod there, or maybe we don't.
Well, Comcast was getting an awful lot of criticism for being a bit of a laggard, and now they're getting a very different look for having been a little more modest in what they were throwing at streaming, and maybe getting this balance from legacy to streaming a little bit better than some of the other companies that were throwing everything they had at streaming before they were actually ready to be able to benefit from that. Every company has a little bit of a different model here. I do think the problem is that Netflix doesn't have to manage a declining business. It can only look forward and build streaming. And all the other companies that are big players in streaming have to figure out how to manage that decline.
Yeah.
And the decline issue is real, and it's going to be significant, and inflation and recession only make it more significant. I do think that they will all have robust streaming businesses. The question is, the market at one point was looking at those businesses as potentially better than the legacy business they're substituting. They're really coming from a world that's very hard to recreate as good a model as the one they had.
We do got to go, but I do want to work this in. John and Jerry, you literally just sold over the last few weeks 80% of your Netflix shares. You heard Tom essentially make the case that this is a Netflix world and all the other streamers are just living in it. So what do you say to Mr. Rogers here about why you sold 80% of your Netflix?
Well, I finally got back above water from a horrible purchase at 219, Scott, just from collecting a lot of premiums, call sales against it. But to your point with Mr. Rogers, he knows a lot more about streaming than I do, Scott. But my feeling is that Freevee, the former IMBD that Amazon is running, is a category killer. And Netflix is not ready to get there as quickly as they need to get there. And then they need the sales force for the ad-supported business model. I don't know that they get there as quickly. That's why I shifted that money. It was under $2 million, but I shifted that money, Mr. Rogers, into Amazon, because at $102 a share, 103, where I was buying it yesterday, I'll take that over Netflix at wherever it is today, 175, 180.
Well, look, Amazon's a gargantuan company, and Freevee's a tiny little pimple in the scheme of what moves Amazon. But you got to keep in mind that Netflix is in over 100 million homes. That's 25 million more homes than ESPN is in today. Their core issue shouldn't be their subscriber numbers, which is what everybody was focused on, a couple 100,000 less here in a quarter. The issue is, are they going to monetize the third that are not now paying? That's their challenge. The advertising model that they are now moving to should help some with that. But that's an enormous accomplishment. That's more homes than any of the cable satellite bundled channels that we used to talk about having full U.S. distribution ever had. And that's not really recognized or appreciated. So I think if you're looking at the sub numbers and who's got the momentum, you can't forget how far ahead Netflix is from everybody else.
I'll make that the last word. It's great to see you.
Thanks for having me, Judge.
All right, that's Tom Rogers. We'll see you again soon.
Thank you.
I know. All right, up next, we do have to get to those buys and sells from the committee. John's unusual activity is coming up as well, and all of this month we are celebrating Pride Month here at CNBC. And here is Ryan Ruggiero. He is CNBC Senior Director of Diversity, Equity, and Inclusion.
The most important thing that I want people to know about the LGBTQ community is that we are everywhere. We are CEOs, CFOs.
All right, so trying to put in a higher low here. Looks like a bear flag for now. I wouldn't be surprised to see a little bit more give back into FOMC. Wouldn't be surprised. Looking for a bounce after FOMC into Friday, OPEX. You know, the market pretty much expecting what I'm sure we're going to get, 75, a hike of 75, and probably some comments about the rest of the summer hikes. To understand where we'll see a bottom, my belief is that we'll see a bottom in the markets, short-term bottom, intermediate-term bottom, that might last more than a couple of days, would be if we saw crude oil roll over, and commodities. If those two were to roll over, then I think people could see inflation pulling back a bit. All right, so those two have to happen. Crude oil needs to roll over. Doesn't look like it's going to do it anytime soon. And we need to see inflation coming back as well. So commodities turn, that would be helpful. Let me go take a look at that real quick. All right, so commodities have been on a tear since March of 2020, as you know. Okay, watching the money flow will give you an insight into what you can expect in the markets. I like to follow the flow. CRB index monthly. All right, so you can see the CRB index is starting to show a potential gravestone doji. Now that would need to trend. That would need to reverse. Okay. So if we see CRB index turn, that would be something. And crude oil.
$120s, whatever it was all the value given to streaming. Now you get it for free. That's the play on Disney.
All right. John Ajurian, wow, you sold 20 positions. Is that right?
That's right, Scott. I've got my highest cash position right now that I've had since 2008, just over 60%. I did a lot of those, Scott, just because I don't know what the next move is going to be. I think 75 basis points is correct today, but I wanted to just trim the herd a little bit and be ready for a significant decline. And if Mike Wilson's right, and he's been right for a long time, I'll be buying back in a lot cheaper than here.
Yeah.
Yeah, good point.
You sold stock in BlackBerry, which I forgotten that you'd even had, and you also sold Gap shares.
Yeah, me too. Yep.
You sold the Gap shares. Just take me through the Gap stock. You also sold calls in a lot of things. I'm not gonna get to. You can tweet those out for people because there's too many to mention. But selling stock in Gap, you sold your position. Why?
Low tick alert -800.
Well, I get emails every day, like many of your viewers, that are basically 60% off, 70% off sales. There's no I know Target has to cut too, Scott, and that's one of the
SPY, some HYG calls coming through.
Target, quite frankly. Sorry, Brian Cornell. But I sold many of these retailers because I think they're just going to flush it. I think they're just going to have to cut price dramatically to move things. And again, it's a broken record, Scott, but that's before they move interest rates up and people start having tougher and tougher credit going forward because of these higher interest rates. So the biggest debtor is the U.S. It's not you and me, Scott, but this is also going to hurt the U.S. pretty dramatically, those non-payments of interest, even though we sort of make it look like we make payments. We don't really. So these bonds, I think, are in trouble still, even at these levels.
I feel like I'm doing a little bit of a disservice to people if I don't read these names. You tweet them out still, but I'll just run through the names you sold calls in. ChargePoint, Cinemark, Lennar, Marqeta, Nike, Palo Alto, Palantir, Square. You mentioned Target, the VIX, the XLE, the XLF, eBay, and Rocket. So things that you have talked about on this program on numerous occasions, you no longer own, whether it's options or stocks. And Doc, you can go into more specifics on that later if you want to, but nonetheless, at least we get that.
More selling into FOMC. HYG, some big trades on HYG. Got 10,000 contracts of the HYG. It's a block trade. $10,000 calls on HYG. Looks like some flow is starting to show up in some of these indicators. Still in a descending pattern, but we could see a bounce maybe back to 77-ish. All right, so CRB index. Where'd you go? Where'd you go? There you go. CRB index. You got a gravestone doji so far. Okay, we're backing off some more into the Fed. Reduce risk, hedge.
Extreme low tick alert.
Amazon.
All right, let's do that unusual activity. John, what do you got?
Well, Scott, both of these are June positions, which means deep end of the pool. These options expire on Friday, this Friday. So Meta's the first one, META. Obviously, the name change not really helping them out much. And they're buying the 155 puts. The stock was about 164 at the time. Second one, this is a call. It's in the HYG, a high yield. They're buying also June, the 7650 calls. And this one was with this HYG, I believe around 74 and a little change, Scott. I'm in the calls there, and I'm in the puts on Meta.
All right, good stuff. We'll do final trades next.
All right. All right, so Meta, we got 105,900 on Meta. There's a big trade on Meta right here. $420? 2024. For 2024. All right, more selling here.
Extreme low tick alert. Low tick alert -800.
All right, some profit taking into strength. Okay, we were looking for a pullback from the highs, so hopefully you took some profits into strength. Fed in 1 hour. 1 hour to go. 1 hour and 2 minutes. Most stocks are responding in kind, pulling back a bit. All right, so a good bit of selling there into FOMC. You shouldn't be really that surprised. Now we had a nice rally back up to the highs of the morning on the Qs, the SPY, IWM, etc. Nothing's changed in my plan for the week. I'm still anticipating that we could see a rally after the Fed event risk comes off, the FOMC event risk. People who are positioned for any sort of pullback with puts or whatever will look for that backwardation in SPY and VIX term structure to back off a little bit. Backwardation is when the front month is a lot more, there's a lot more premium in the front month versus 3 months out. You'll see the spike in VIX will get way up to the highs, and then over a little bit of time, maybe a few days, that event risk pulls VIX back down and looks more like the 3 month. where we get into contango, where the 3-month out is more expensive than the front month. So right now we're looking for VIX to come back in after the event risk rolls off. We're looking for a rally into after FOMC. Doesn't mean it'll happen, but everybody knows what the Fed's going to do. Markets have basically priced it in on the pullback we've had recently. Can we move lower? Absolutely. Am I positioned for it? Yes, I am. I have hedges on QID, UVIX, and RWM for the IWM, small caps. Okay. I don't have any puts right now, and I don't have anything other than UVIX for volatility. If the Fed comes in heavy-handed and drops a bomb, a single point or higher than 75, then yeah, we could probably crash the markets. I don't think Jay Powell is going to do that. He hasn't shown anything in the past that would suggest that he's going to crash the markets. I think he did a great job through 2020 during the COVID crisis. I think he did a good job of threading the needle. The printing of money, I don't know who exactly you can blame for that. I mean, I got some ideas, but you know, it's the inflating of the money supply, making everything, making the dollar, trying to make the dollar weaker, but instead with dollar popped higher, and it's taking more dollars to pay for the same things that you paid for last year. You see that in inflated prices. Anyway, so we have to wait and see what the markets do. That's all you can do. I don't have a crystal ball, neither do you. Again, if the markets rally into OPEX, I'll be using that as an opportunity to take more risk off. I'd like to get down to 40% and keep my hedges on. The reasoning being, I don't think we're done with this downtrend. Like 2008 and 2000, it took 18 months to get out of the mess that we had. 2007, 2008 was also a financial crisis. Inflation is out of control like it was in late 1970s. So once the event risk comes off, I'm anticipating a rally and I'm positioned for it. Maybe scalp some things over the next couple of days, like we've done with Alibaba. Some of you are trading Tesla or Amazon, TQQQ. That might work as well. Chewy was looking better this morning. What's Chewy doing? Chewy, Redbox, those are still up 6% and 8% respectively. Roblox is up 8%. Roblox. We had Target's up 3%. Tesla's up 3%. I really don't think Jay Powell's going to come in heavy-handed, guns a-blazing, and raise rates a full point or something like that. A lot of people talking about interest rates should be up in the 4 and 5% range. Some are saying 2%, 3%. All we can do is watch the money flow in the weeks ahead to tell us where institutions are positioning or pulling money back. So once we see the money flow, then we can position with more focus. Right now we're just bouncing. All right, I'm going to make something to eat for lunch. It's 1:05, and we got 55 minutes to go. So let me make some lunch. Make sure my daughter is okay. She's downstairs. She slept in today. Teenagers. Okay. I'll be back in a couple of minutes. All right. So expecting choppiness between now and FOMC. Okay, let's see. Keep an eye on VIX. Let me put a I'm going to put VIX here. VIX. All right, I'll be back in a couple of minutes.
Just ahead of the US FOMC rate decision, we have put out a statement prep document for those who are interested in reading. Just going through this document, we are seeing that Wells Fargo gave their view, a bank itself. Prior to Friday, they said that on June 10th, we shared the universal consensus that the FOMC would hike by 50 basis points at the June meeting, but the higher than expected inflation print for May now has us looking for a 75 basis point rate hike. This expectation was reinforced by the press reports on June 13th that seemed to have been designed to recalibrate market expectations regarding the potential magnitude of the rate hike. Wells Fargo adds that we also look for a meaningful upward shift in the so-called dot plot, which would indicate that the Fed policymakers believe even more monetary tightening is appropriate in the coming quarters. We look for a median dot to shift up to 3.375% at the end of this year to 4.125% at the end of next year. We also expect the FOMC will raise its inflation forecast for 2022, but also paring down its GDP growth forecast this year. We are also seeing views from ING that was published on Friday, June 10th, saying that with the near-term growth story looking robust and inflation remaining well above target, the Federal Reserve is set to hike by another 50 basis points and confirmed that another 50 basis point move in July remains on the card. Another hawkish set of Fed dot plots should keep the dollar supported near the highs of the year. The Federal Reserve is widely expected to follow up May's 50 basis point interest rate increase with another 50 basis point hike at the forthcoming FOMC meeting. This will be taking the Fed fund rate target to 1.25% to 1.5% during the press conference. Fed's Powell is set to confirm that a third consecutive 50 basis point hike in July is the most likely path ahead. The Fed is also expected to continue to allow $30 billion of Treasury securities, as well as $17.5 billion of agency mortgage-backed securities to mature and roll off the balance sheet, increasing the $60 billion worth of Treasuries and the $35 billion worth of MBS in September, or by September. ING adds, however, there is a debate as to what happens thereafter. Some officials want the Fed to continue with 50 basis point hikes after this to ensure that inflation is brought under control. But this does risk moving policy deeply into restrictive territory, as well as heightening the chances of a recession. Others argue that there is already evidence of the growth outlook weakening and inflation pressures tentatively softening, which could justify a further pause in September. Also seen from Citigroup, saying the CFO Mason, cited by Wall Street Journal, saying if you look at the market today, we are looking at a rate increase that could be as high as 75 basis points in the next 2 meetings. Wall Street Journal adds that the Fed is likely to consider a 0.75 percentage point rate rise this week. Officials have signaled that plans to raise interest rates in half-point increments before the recent deterioration in data. Barclays adds that 75 basis points is what they expect, raising it to 1.75%. Deutsche Bank expect a 50 basis point hike to 1.5%. Also, just to look at the previous release, the last US rate decision was released on May 4th at 2 p.m. Eastern Time. It came in as expected as a 50 basis point hike. Major news wires are also seeing a 50 basis point hike this time. Just a reminder for those who'd like to read that prep document, it is available at the top of the feed. ECB's Lagarde says we cannot be dominated by fiscal issues. We must deliver our price stability mandate. $96 counterparties take $2.163 trillion at the Federal Reserve Corporation. ECB's Lagarde says fiscal authorities should ensure distributive impact of energy prices are addressed.
Okay, I'm here. I'm just eating lunch. I'm out of earshot. I'll be listening and watching.
Speaking to us just yesterday, about 30 minutes to the FOMC decision, 50 basis points is the last guidance. We got 75 basis points is on the table. Joining us now for more insight on what is next for the Federal Reserve, Ajay Rajadaksha, Barclays Global Chairman of Research, and Gina Martin-Adams, Bloomberg Intelligence Chief Equity Strategist. Thank you both for joining us. Gina, let's start with you here. The markets are actually seeing green on the screen when it comes to the stock market. We just heard Anna Hand say 50 basis points could spook the market. What spooks the market? What helps this market rally?
Yeah, it's a really tough meeting, honestly, to handicap given the volatility that we've experienced over the last couple of days. You would naturally expect after Monday's just severe decline, we would be in something of a rally mode. But sector positioning right now does tell you a lot about what the market's thinking. The market does appear to be pricing for the Fed to increase rates by 75 basis points at this meeting, maybe at the next meeting as well, and then start to tail off by the end of the year. Our work would suggest also fair value of the S&P 500 is probably close to about 4,000, as long as that case does indeed play out.
This stream is sponsored by To The Tick. Get free daily pivot points, Fibonacci, and market profile levels by signing up at tothetick.com.
As the pace of earnings growth slows materially as well.
And of course, we're going to keep all eyes on the stock market, but we have to ask, what kind of precedent does this set? Barclays weighing in on this, saying historically the U.S. Central Bank has avoided surprising markets, say by going 75 basis points when it's not priced in. The Fed should want to surprise the market by being more hawkish than expected, given the magnitude of upside surprises in recent inflation data. Part of the team who put that together, not on Monday, not on Tuesday, but back on Friday, we actually had that CPI report. Ajay, thank you for joining us. You were part of this call. I have to ask, though, if the idea is to surprise the market expecting 75 basis points, does this set the stage for 100 basis points, if not today, perhaps in the next meeting?
No, I don't think it does. I think the Monday leak, and regardless of who leaked, the fact is that it's a leak that the market pays attention to, has paid attention to in the past, was the surprise. On Friday, we felt like you said, price pressures in that report were broad enough, they were accelerating enough that the Fed needed to make a statement hike. This is that statement, and I think 75 basis points is going to be enough.
Ajay, I have to ask, it's funny, we're talking about 75 basis points, 100 basis points, but if you actually look at euro-dollar spreads in the options market, pricing in those rate hikes going into the next year, or rate cuts, I should say, The market is also pricing in rate cuts going into 2023, matching some of the recession calls. I have to ask, is that a fair assessment to make, or the market's getting that wrong?
I think it's a little bit too aggressive right now, but the fact is the economy has slowed quite a lot. Today's retail sales number tells you, and the thing is, quite honestly, the rest of the world is slowing enormously more quickly. You had a previous guest talk about, China rebounding. We don't think China is rebounding at all. We think there is a risk that China in 2022 ends up being weaker than in 2020. And that's the kind of thing that the United States, as large an economy as it is, can't, might sell get past.
I did make you some comments from Barclays and against what UBS was saying earlier. Julian, let's get Bloomberg Intelligence back into the mix here. I want to talk about liquidity, though. We've talked about bond market liquidity earlier in the show, but stock market liquidity is still an issue. Quantitative tightening begins today. I have
Hi to Alert plus 800.
Market drop we've seen is a liquidity.
High tech.
When do we see that get resolved at a time when the Federal Reserve is being restrictive?
Yeah, I don't think there's a liquidity issue in the equity market. I think the equity market is frankly operating very normally and very consistent with past experience. We're just in an environment where rates are resetting very quickly after being in an environment where rates were enormously supportive for stocks. We now have not only policy rates going higher, but some quantitative tightening starting to feed through the system. We're just moving to a state of balance from a state of extraordinary imbalance, frankly, and that does create a lot of volatility in the equity market. But there are no signs of true illiquidity emerging where, for instance, trades aren't getting done. It's pretty rational, frankly, just given the vicious shift in rates that we've had through the equity market repricing to the degree that it is.
Gina Martin Adams, Ajay Radhakrishnan, Barclays Global Chairman of Research, of course, GMA of Bloomberg Intelligence. We thank you both for your time. 30 minutes to the FOMC decision. Of course, we do have green on the screen, about 1% gains on the S&P 500. When we're looking at the 10-year yield, though, yields are lower in anticipation of this FOMC decision. How much of this is fundamental? How much of this is technical? Well, we'll discuss all of it. Tune in for the Fed Decides. That Fed special coming up next with Tom, John, and Lisa for Bloomberg Markets. That does it for me. I'm Katie Gupta. Stick with us. This is Bloomberg.
Travel with one tell you folks they could say by bundling ugly combinations. But here's the real secret. Eye contact. We just had a moment. There I go.
You put a woman on Mars. You are the fourth global criminal. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you don't just get news. You get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Listen about art and attraction. Well, art is essential in the democracy. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy, and it helps people understand how other cultures live, and it just brings out a kind of humanity in all of us. But there are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, and they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
London, in San Francisco.
To recap the headlines, do not miss the story.
Thinking about things like that.
For the past 2 weeks, made it clear it wants to go higher. But that will sleep by the idea that geopolitical tension is rising.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance. The Fed Decides.
Live on Bloomberg TV and radio for our audience worldwide. It's a good afternoon to you all. Your equity market positive 1%. The big Fed decision just around the corner in TK. Some monster expectations.
It is. It's absolutely extraordinary, John. And I think what's so interesting here is we go from the emergency ECB meeting to, I believe it's Christine Lagarde, a commencement speech at the London School of Economics. And then we go to a Fed meeting. Can you imagine what Chairman Powell's thinking was front run by the ECB?
Well, he also front run himself to a certain degree, Lisa, based on the media reports we had earlier this week. We're expecting a big move. A lot of people changed their call to 75 basis points. Those that were looking for 50 are now looking for a little something more.
Well, especially because the Fed whisperer, so people think in the Wall Street Journal reporting that they were actively considering a 75 basis point rate hike. What I find interesting is increasingly the notes that I read say that this will be a positive for markets at a time where they're looking for some conviction from the Fed, some way to get ahead of what we've been seeing with respect to inflation reports getting ahead of where they'd like to see them.
I've heard this so many times over the last couple of days that this Fed needs to go big somehow, Tom, to restore confidence. Is big 75, or do they need to indicate they'll go again a little bit more? Listen to these calls, Tom. Barclays 75, Deutsche Bank, Goldman, JP Morgan. I'm going to run out of fingers. Throw in Jefferies, Nomura, SocGen, TD, Wells Fargo, Standard Chartered. The long list, Tom, got a whole lot longer over the last day or so.
It suggests they've lost the dialogue. Maybe the modern phrases have lost the plot, and they got to get the dialogue back. Right now, John, the markets are the chairman of the Federal Reserve System, and that is not a good outcome.
And the markets have been driving things in one direction since that CPI print on Friday. Lisa, let's just build it up, frame it. The 2-year yield in 5 days moved 70 basis points. The S&P 500 in 5 days moved more than 10% in the other direction. Brutal moves over the last week coming into this one.
And today, people perhaps are saying that we've priced in a 75 basis point hike. We've priced in whatever the Fed will throw at this market. If that holds, then perhaps we could create some bottom. But the pace of these moves, just to size and scope it in basis point terminology, that 2-year move was the biggest since 1987. This is a new territory for the modern market.
With Lisa Abramowitz and Tom Keene, I'm Jonathan Farrell. Your Fed decision is about 25 minutes away, and your price action going into it looks like this. On the S&P 500, positive by 1%. On the Nasdaq 100, up by 1.7. Yields come in 7 basis points, but 340. What a change on a 10-year. The last time the Fed met, that meeting, and the market closed that day, May 4th, Lisa, the 10-year 293. We've moved a long way since then.
And the scope for
how much it could potentially move has shifted as well. I think this is important, not just now, but in 6 months' time. The idea that people are talking about 10-year yields easily at 4% or above. How does that shift the entire investment thesis across all assets? And we're hearing more of that from a whole host of investors. Coming up, we have some viewpoints that are so important to listen to. Deutsche Bank's Matt Lazzetti and TD's Priya Misra both taking us up to the Fed rate decision at 2 p.m. Then immediate reaction from Guggenheim stock miner and SocGen's Subhadra Rajab. How much are we looking at what the market has priced in versus what the Fed signals down the line? Do they start to talk about a hard landing and what they see there? Finally, some post-Powell commentary from someone who has gotten it so right. Former New York Fed President Bill Dudley, who has been much more hawkish than many of his compatriots, and he has been right, at least so far, as well as BlackRock's Jeff Rosenberg. John, it just, to me, I think that that's really the takeaway. At what point do economists come out and say, our projections were completely wrong, we're taking a look at why, and here's how we're completely pivoting?
Here's the thing I need to build on through this morning and into the afternoon. So we started earlier on today by talking about a Fed that would maybe change the timeline, but perhaps not the destination. And if you think about the work of Bill Dudley over the last, I'm going to say 12 months or so, his main point wasn't that the Fed had to front load and all this stuff. His main point was that the destination was going to be a whole lot higher than people thought. And the big shift I've seen in the last couple of days is this front loading call. 75 today, maybe 75 at the next meeting. I've seen very few people change their view on the ultimate destination of where this Fed is going.
Yeah, I mean, the terminal rate jargon that we see is 3-year, 3.25, 3.5. Maybe there's, what do you think, John? A handful of people out of 4%, or can we go more there now?
Well, let me frame this for you, Tom. When they met in December and they put out their forecast, year end on the Fed funds rate, do you know where they saw the Fed funds rate year end for 2022? 90 basis points.
Right.
Tom, that was back in December. Think about where we are now. We could have a 75 basis point move in this meeting alone in 20 minutes time.
We're going to bring in the conversation there, but also what we see across equities, bonds, currencies, commodities. Through the morning, what I've been watching is a weaker euro, just simply giving way, maybe something to do with European growth in the call there. Joining us now, Matthew Lazzetti, Chief U.S. Economist at Deutsche Bank, who modeled out a long timeline to American recession. Matt Lazzetti, just to give us an update on your call of a number of weeks ago, can you pull forward your call of American recession?
Sure. First, thanks so much for having me. And I think all the discussion that you're just having about not only front loading, but thinking about the terminal rate is exactly what the thought process that we've been going through. Prior to last Friday's CPI report and the data on the inflation expectations from the University of Michigan, we had a terminal rate of 3.6%, which was looking pretty aggressive. After that data, we moved the terminal rate up to 4.1%. And given the fact that we think that the Fed is going to front load that, we see that the market and the Fed getting there by the first quarter of next year. I think that this has intensified our view on recessions. I think it is right in line with that. The Fed has to be more aggressive. Will ultimately have to hit demand, push the unemployment rate higher. So if anything, I think that it has certainly supported our view on a recession next year and has brought the risks that happens earlier than what we have forecasted.
And Matt, to the people that don't have the collective memory of Peter Hooper and an ancient David Fulker's Landau, when you say a terminal rate of 4.1%, a lot of people will ask, will that break the American economy? They just assume it will.
Sure. And I think from the Fed perspective, and what I think we'll hear from today is that not necessarily that the Fed wants to or needs to break the economy, but they need tighter financial conditions. They need demand to come in, and they likely need the unemployment rate rise. And I think that'll be a big focus of the S&P, their forecast today. We think that needs to happen. I think we're seeing some evidence of it already. Certainly the housing market with 6% mortgage rates and the evidence that we've seen there is happening in good spending, as we've seen with the retail sales data this morning. But the Fed needs to have growth lower. And ultimately, we do think that we kind of need a recession in order to get inflation back down to target over time.
Matt, how important is it for the Federal Reserve to come out and give some sense of control over the deterioration in markets, that they're going to raise rates aggressively, but they're going to have control in a way that the market does not feel? Right now, we see it feels like things are breaking down a little bit with liquidity and with 5 standard deviation moves, as Tom was pointing out this morning. Is it too much?
Yeah, and I think it's a difficult messaging process for 2 reasons. One, they need tighter financial conditions, and so yes, the levies have been volatile, perhaps a bit disruptive, but the directionality of them, I think, is in the right direction from the Fed's perspective. And I think they need tighter financial conditions from where we are today. The second reason it's difficult is that we've seen certainly over the past 6-7 months.
All right, so we had a rally back up to the highs that we put in this morning, and again at 12:30. All right, so if you're unsure, if you're not positioned properly, I'm basically delta neutral at this point. Okay, which means if stocks go up, my hedges will pull back. However, I'm selling covered calls against those hedges like UVIX and QID. So if stocks go up, my hedges come back in. So I have a bit more equity exposure than I do hedges. Now, if stocks pull back dramatically, my hedges will shoot higher just from the volatility expansion. Then I'll need to roll my covered calls up and capture more premium so that I can get my cost basis down. Currently, my cost basis on UVIX is now below 1250. Yesterday was 1285. I rolled some calls up and out for a small credit. So my cost basis is below 1250 now. And if you look at UVIX, all right, let me turn this down. Okay, it just occurred to me that Bloomberg, all they're doing is talking about what's already happened and speculating on what might happen. Instead of talk, I wish they had a program on money flow. They won't do that though, because if they talk about money flow and what institutions are actually doing, the institutions want to have that edge. Unless you understand or have indicators that follow the money, which you should. If you are a member, you have my 20 indicators that I look at, and those are posted in the Scans temporary channel. They should be. Let's see, Scans temporary. All right, so I'll post them again in the Scans temporary channel. Those 20 indicators that I watch on a regular basis to see where money flow is headed. All right, let's see. Anyway, so I'm delta neutral. So if the markets go down, my hedges go up. And because of the volatility, they would expand faster than my equities pulling back. Unless everything went to zero, which I really don't think is going to happen. Okay, let me post these links for you guys and ladies. All right, I just posted that in the Scans temporary channel. Okay, so I'm delta neutral. So I don't care what the market does. Once the markets react, I can then start to back off on either my positive equity exposure if the markets move lower, or back off on my hedges, or collect premium and close some covered calls. So I think that makes sense. Right now, the markets are just gyrating back and forth, back and forth. Why get yourself all crazy looking at Tesla move from 676 up to 686? Why make yourself crazy over that? Let's see what happens after the Fed. So for the excuse me. I just had some grilled boudin. Boudin is a sausage that you get down in Louisiana. John knows what I'm talking about. Boudin. Had that for lunch. Cold couscous for lunch. Had some grilled boudin. All right, watching VIX is still climbing a bit here. So I'm delta neutral. All right, Facebook. Boudin's good sausage. Good sausage. Meta keeps moving higher. Okay, so Alibaba 113s, 114s for Friday. A lot of Baba flow. Tesla, Nvidia, mostly on the call side. Tesla fading a little bit right here. So anyway, being properly positioned for a major event is crucial. You know, the markets go up, my hedges pull back, but the volatility that collapses on those VIX event calls or UVIX, I capture that premium and I keep doing that over and over and over to bring my cost. Hopefully, I'll get my cost basis down below $10 per share for UVIX. That would be awesome. That would be freaking awesome. All right, so UVIX, two times the VIX long future. Okay, so as you know, over the last about 3 weeks, I guess I've started trading this about 3 weeks ago. I wanted to see how it worked related to VIX, so I could give you a good read on it. Get used to how it trades relative to the VIX. Sometimes it does give you 2 times. Sometimes, I guess, because of the assets they have to go in and out of. Sometimes it doesn't follow exactly VIX. Anyway, so on these moves higher, I'll sell premium. When it pulls back, I'll close the covered calls. And then I'll wait for the next bounce. I'll do it all over again. So you can see the low here is 1320. I'm down at 1250. And I still have the hedge just in case the markets go nuts and we drop off. All right, so that's UVIX, watching that. Waiting for the Fed. And we're fading a little bit. So I'm delta neutral. Basically delta neutral.
Extreme low tick alert.
Don't worry about all those extreme ticks and stuff.
2 p.m. Eastern Time, we are expecting the U.S. interest rate decision, forecasting 1.5% with a 50 basis point hike of 50. The previous was 1%. We are also expecting the FOMC statement as well as the FOMC economic projections. For those who would like to go through our FOMC rate decision and statement prep document, that is available a little down the feed at 1:08 p.m. Eastern Time.
All right, so more profit taking. We won't get a good idea of what the markets are going to do until after, I would guess, after Jay Powell speaks, he generally will speak around 2:30. VIX still pushing back up towards the 1130 high. VIX moving back up to the highs. I have UVIX showing right here. UVIX. So if volatility continues to stay in a range, elevated like it has been, technically and theoretically, I could get my UVIX down to like $5 cost basis of $5 per share, or lower, by just continuing to sell covered calls and making collecting that premium. My original shares I still own. I own 500 shares, and I've been selling covered calls against that. Where are we right now? We're at in 19. Yesterday we were in the 20s. So I sold some, and then yesterday I was trying to roll them out to a higher strike. I had the 16s. I wanted to roll out to 18. Those were going for $10 each. The 18s were going for $10, and so were the 16s. A month out, the 18s a month out. So the 18s for September were $10, and the front month, what was trading for, let's see, this is June, for July, those were going for $10 as well. So I couldn't get I could have done it equal, but I wanted the credit. I wanted to get about $1 credit. I got that today on the UVIX. So it's a, what would you call it? It's kind of a thesis that I'm testing to see how UVIX trades against VIX. And in the process, while VIX is highly elevated, I want to see how far I can get my cost basis, how much lower I can get my cost basis and still hold on to the hedge. The critical thing is, because we're in a downtrend, I want to hold on to that hedge, because a lot of people are expecting VIX maybe next week or the week after. If we do get a rally, many people are expecting VIX to be up in the 40s. People that I've been talking to, and for SPY to be down at 360 or even lower. Now that might make you a little upset, but planning ahead, and like playing chess, you want to be 12 moves ahead, right? So my chess moves were to stick with the strategy that would keep me delta neutral and still be able to scalp intraday, like on Baba. Baba has been a good trade. And be able to do that on a daily basis until we get out of this stupid downtrend. There we go. SPY's going. SPY's going.
Hi, took alert plus 800.
All right, so we've got less than 4 minutes to go for the Federal Reserve. Jay Powell. Most everyone's anticipating that we'll get 3/4, 75. We're trading at resistance again. I switched from Dr. Pepper to Celsius. This stuff is really good. Celsius. Some of you may be familiar with Celsius. No high fructose corn syrup, no aspartame, no preservatives, no artificial colors or flavors. It's pretty good too. I mean, I put a little bit of apple cider vinegar in there and some lemon juice, some pure lemon juice from Italy. And that does good for with the intermittent fasting. I've been doing intermittent fasting. I won't eat breakfast. I eat lunch between 12 and I eat again between 12 and 6. And then I don't eat again until the next day. And really helping with insulin. And I'm feeling a lot more focused, and which is good for you guys. I'm a lot more focused. My brain is going like 90 miles an hour right now. Just sitting here waiting for the Fed. We've got 2 minutes to go, less than 2 minutes to go. This English guy that's on Financial Juice, he gets really excited when the news comes out. He goes, "Arr!" He just like blurts it out.
One minute to go now. I'll be reading the U.S. interest rate decision.
1 minute to go.
Hi, took alert plus 800.
Okay, we're starting to pop here. Don't forget to take some profits off into strength and then reassess the markets after, say, 3:30. Take some profits off into strength. That's what I'm going to do. Where are you, Baba? There you are.
Hike 75 basis point hike, 75 basis point hike. The 1.75% higher than the expected 50 basis point hike.
Everybody's expecting 75. That's what's priced into the market, 75. There goes Tesla.
Robust. Unemployment has remained low. We are also highly attentive to inflation risks.
All right, there goes. Holy smokes. Here we go. There we go. Nice follow through.
By Fed officials, forecast rates above 4% in 2023. Fed repeats it sees ongoing rate increases be appropriate. Fed forecast shows 2022 unemployment at 3.7%, 2023 at 3.9%, and 2024 at 4.1%. Fed median forecast shows 2022 inflation at 5.2%, 2023 at 2.6%.
All right.
Fed says inflation is elevated due to supply and demand and broader pressure. Fed says economic activity picked up after edging down in Q1, and Fed raised its IOR forecast to 1.65%, discount rate at 1.75. Thus, the Fed raising its IOR to 1.65% and discount rate to 1.75%. Fed says balance sheet reduction proceedings at announced pace. Fed forecasts show longer run rate at 2.5% versus 2.4% in March.
All right, so that event risk is going to come off the table. VIX is spiking up here, so take some profits off. VIX spiking.
Also seeing Fed policymakers' projections show that they expect to start cutting rates in 2024.
VIX spiking. I would take some profits off there into that spike.
So just going over some more Fed comments. Fed says overall economic activity appears to have picked up. Fed repeats that they are
All right, so choppy at the moment. Choppy chop.
balance sheet reduction will proceed as planned. Fed says we are prepared to adjust policy stance if risks emerge that could impede the attainment of its goals. And that we are assessing appropriate policy stance. We will continue to monitor the implications of things.
Fed's talking about growth to be about 1.7%, down from 2.8% in March. Median view for the Fed funds rate at the end of 2022, 3.4% versus 1.9% in March projection. PCE inflation at 5.2% in 2022, 2.6 in 2023, and 2.2 in 2024. Median long run forecast 2%, previous 2% PCE inflation.
Previous being 3.5%, 3.9% in 2023. They also see in 2024 it being at 4.1%, with median long run forecast at 4.0%, previous being 4.0% as well.
All right, let's see what the markets do after about 2:30, 3 o'clock. See what happens after Powell speaks.
They also see it at 2.6% in 2023, as well as 2.2% in 2024. Median long run forecast at 2.0%, same as the previous at 2.0%. Fed sees GDP growth at 1.7% in 2022, with the previous at 2.8% and 1.7% in 2023, 1.9% in 2024, with the median long run forecast at 1.8%. Same as the previous at
Low ticker minus 800.
Also, just looking at reactions, we are seeing the Dixie move upwards. Gold moving slightly towards the downside, as well as US oil. Slight downside movement on GBP USD, Euro USD, and Bitcoin slightly moving downwards as well. We also saw US 10-year Treasury yields rising to 3.425% after briefly dipping on the Fed statement.
All right, VIX still pushing the highs here. Expecting VIX to come back in. VIX looking for it to come back in now.
This stream is sponsored by TickStrike.
Yeah. AERC is up $6 on the day. AERC is up $6. plus 4. All right, 60. All right, AERC is plus $6 or more, depending on when you got in. AERC got plus 6 on those. Shares, I just have shares since it doesn't trade options. All right, AERC looks like it wants to keep going. VIX, I got a feeling VIX is going to fade. The event risk is dissipating. All right, so we're just sitting here waiting. Okay, check out the HYGH. It's the hedged high yield bond ETF. That's up 1.5%. What's HYG? HYG 1.3. All right. All right, looking for a SPY to bounce here, looking for the money flow. Money flow keeps coming into these. All righty. All right. All right, we're starting to rally now. VIX is coming back in. Take your profits off. Take your profits off of VIX calls. All right, we're trying to move back up to the FOMC spike highs. If we start to rally above 280, stay above 280, excuse me, if we the Qs get above 281, 282, look for a follow through SPY. We got a few more blocks coming through SPY. Expecting a little bit more chop until after Jay Powell speaks. There goes Tesla. Tesla's starting to move. VIX is backing off. Amazon is trying to take back the high of the day. Alibaba. I'll talk more about Alibaba over the next several weeks, but I think Alibaba at the current level has an edge over Amazon as far as the comparison to Amazon that I shared in the trading room earlier this morning. Look for Amazon maybe to back off a little bit after, maybe we'll get a little bit of a rally first into OPEX on Friday. But on the long run or medium term, I'm looking for Alibaba to outperform. If you look at Alibaba, there's some similarities here to Amazon. Let me just find it real quick. It's very similar to, if you look at Amazon, and you go back to 2000, 2002. All right, let's go back. While we're waiting for the markets here, I'm just going to go over this real quick. Two thousand 2002. I was looking at this the other day when we started looking at Alibaba. I don't want to see all of that. 2000, 2003, December. Okay, look at Alibaba. All right, let me just show you Alibaba real quick. All right, so Alibaba. Well, I can't do it here because I'll give you to. Well, let me do it that way. All right, so here we go. Here's Alibaba. Okay, now look at the chart. This descending pattern back in 2000, 2001. Now look at Alibaba weekly now. Very similar price action. Okay, and with growth, with sales increasing, all right, when sales are growing, we're looking at an investment in Alibaba with the potential for future appreciation because we've got sales growing and yet price action in Alibaba has come back a bit. Now look at the chart again. Now look at Amazon. This is Amazon. Crap, I lost it. Sorry about that. Here's Amazon now. Back in 2000, 2001. Very similar. We're like in the early stages right here in 2001 that we're starting to turn. Okay. One more time. That's Amazon back in 2000, 2002 in that period. And Baba now. Same thing was going on with Amazon back then. Okay. All right, we're just starting to change direction. Now, there is regulatory risk. The Chinese regulatory agencies, there's sort of a remote possibility right now. The government's, I believe, trying to ease rates when the Fed here is tightening rates. So I'm looking for Alibaba. Now, it's not just Alibaba. So to make myself a little bit more confident, I would be looking at other stocks in the Chinese group. I'm not uber bullish, by the way. Currently, I'm trading calls on Alibaba. I have the 110s for next week. And but I want to see all of these stocks moving higher. We mentioned EDU. We mentioned EDU early in the week and late last week. We were looking for a follow through in EDU. We got that. And we're looking for other stocks in the group to continue higher. FXI, the large caps. I was looking for Pete Najarian to mention it. He did, I believe, on Friday, or maybe it was yesterday. I forget. But he did mention it. We're looking for FXI to continue this bullish trend reversal. Okay, 50-day, price below, flatten out, moving averages now, moving averages up and to the right. So we're looking for FXI to continue higher. I would expect that VIX and VIX and SPY will continue to chop around until after Jay Powell speaks. But this idea with Alibaba, I think is going to work out. So for now, I'll just trade calls. At some point, I'll take the profits from the calls and I'll buy shares, and I'll keep trading the calls and keep adding to the shares so that I'm trading with profits in the shares. So in the sense, I don't want to see the profits disappear, but I'm trading with less risk because I'm trading using the profits I'm making on Baba calls to buy shares. And what I'll do is I'll probably take those shares and probably gift them to my kids if I can do that. Our account, I do have their accounts on Thinkorswim, and they're all linked up with Ameritrade. So anyway, I'm watching all the stocks in the group. All these Chinese stocks are making bullish trend reversals. And that confirms what I'm seeing. All right, TAL, we talked about TAL yesterday, along with EDU. That's probably going to keep going. All right, so EDU, same business. EDU has already taken off. It's about 2 weeks ahead of TAL. TAL is fairly inexpensive. Doesn't move that much. Moves 47 cents. So if you give yourself a 75-cent stop, look for $1.50 upside. That's a good risk reward. If these Chinese stocks continue to move higher, that's a big if. 10-cent music, just now breaking trend, 10 cent. TME. VIP Shops Holdings. Where are you, VIP Shops? It's not in here. There it is. Okay, VIP Shops Holdings. Trending. Note prices above the 921.50 and 200-day moving averages, moving up and to the right. Looking for a follow through. Watch AERC. Looking for that to pop as well. All right, so that's enough. But Chinese stocks are all moving together. And over the next several weeks, I plan on trading Baba on dips unless it starts to fail miserably. Okay. So we're waiting for the Fed, Jay Powell, to speak. Looking for markets to digest this event risk and to bounce for a few days. If we don't bounce, we got hedges. If we do bounce, those hedges will pull back a little bit. And in addition to that, those hedges, the premium we're selling against the hedges as volatility expands, I sell it. And when volatility collapses, I collect it again. I buy back those covered calls and collect the premium. Pretty simple strategy, but it works pretty good. And I've been practicing on UVIX, for lack of a better term. I've been practicing on UVIX for the last 3 or 4 weeks with good results. My cost basis is now below 12.50. All right, so I'm seeing lots of calls on Amazon, Nvidia, Meta, Tesla, Uber, Wells Fargo, Apple, Netflix, dominating the flow. Apple, Cleveland Cliffs, the 16 strike, Rocket Mortgage, Rocket RKT. Is that Rocket Mortgage? RKT. Rocket Companies. I guess it's Rocket Mortgage, right? All right, that looks pretty ugly. That continues to move lower. I'm glad I refinanced when I did. I refinanced. I have an effective rate of 2.85% on my mortgage. And I did that, 8 months ago? It was like December. It was December. November, December. So as far as inflation goes, if the dollar, if I'm paying for my mortgage with devalued dollars and my payments are not going to go up because I have a fixed rate mortgage, then that's helping with inflation. If you're renting, much more difficult. Unfortunately, interest rates are still moving higher, so harder to buy a new home for a first home buyer. Maybe you buy a condo, something less expensive. I don't know. Reminds me of the late 80s, 1986, 87, when I moved to Jersey. Interest rates were at 8%. Mortgages were at 8%. I still bought a condo back then. I wasn't really that knowledgeable about financials at the time. But I was determined to learn. So I read everything I could read. Reading is a good thing. I read everything I could find on financial markets, how people that make money were doing it. Peter Lynch and other people after the Black Monday, Thursday, Friday into Monday, that 33% meltdown in the markets in 3 days. All right, market's moving a bit lower right now. So once again, as the markets move lower, my hedges are moving higher. I'm delta neutral. And once we get a trend going, I can adjust those hedges if I need to, whether it's buying back some covered calls or selling more or rolling out. I am anticipating that we'll have a short covering rally into OPEX on Friday, where we can sell some into strength, reduce our risk, hold on to the hedges, because I do think that there's a possibility S&P does move lower. Okay, VIX is moving higher right now. Okay, markets are pulling back. Okay. VIX still pushing higher. If you know anything about Peter Lynch, he spent a lot of time at Fidelity. He emphasized the importance of keeping your decision-making process simple. That's the crux of what I've been talking about for the last hour and over the last few days. Hedge, reduce risk. And those hedges, as I was practicing UVIX, UVIX and selling covered calls, I was keeping it pretty simple. I wanted to get myself my funds and my retirement account as close to delta neutral as I could and still have upside exposure that if we do pop to the highs, I will follow through. So that's one of the principles I learned from Peter Lynch a long time ago. One Up on Wall Street. I think anybody who's been in this business for a while, you've read that book. That crash and that Black Monday, the markets dropped 22%, 23% in one day. That was Black Monday. That was the largest one-day drop in history, 23%. So if you think right now is volatile, it's good to have experience and learning from experience that hedges are appropriate right now. A lot of people were panicking back then because you couldn't get through to your broker, as people would famously tell you, brokers weren't picking up the phones. The expression jumping out of your office window. So I'm just sitting here as I'm yammering away. I'm just waiting for the markets to settle down. Fed is talking. Jerome's talking right now.
Larger increase is warranted, and this continues the approach of expeditiously raising rates. This will help ensure longer-term inflation expectations remain well anchored at the 2%.
All right, let's just hear what he's got to say.
Monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators
Extreme
of
high tick
inflation
alert.
expectations
High
have
tick
risen,
alert plus 800.
and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty
Extreme
where the
high tick
economy will
alert.
be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation
High tick alert plus
and
800.
determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle type
Aggressive buyers on the futures. We got 38.25, 38.25 supply.
Extreme high tick alert.
Extreme high tick. There goes SPY. All the stocks are ripping higher.
to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Two related questions. Chair Powell, do you feel you boxed yourself in with the language you used at the last press conference on 50 basis points?
Stupid journalists.
And would you please give us
All right, so got a nice bounce here. Most stocks are bouncing. There goes Alibaba.
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve and they understand
Extreme high tick alert.
our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performance.
Really nice move here. All right, I'm going to buy those covered calls back again. My endeavor is to get my UVIX cost basis down below 12. All right, above 38.50.
We got the CPI data and also some data on inflation expectations late last week, and we thought for a while, well, this is the appropriate thing.
High tick alert plus
So the
800.
question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Thanks for taking our questions. Gina Smith with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding
Extreme
how
high tick
aggressive
alert.
you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure. So when you take a step back, what we're looking for is compelling evidence that
All right, we're right up against supply right here.
and that inflation.
There goes Chewy.
We'd like to see that
Chewy.
in the form of a series of
Chewy gone.
monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation.
All right, everything is popping here. Jeez, look at this market. Holy smokes.
Have risen, and projections of this year have moved up notably. So we thought that strong action was warranted.
TQQQ going.
And today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction,
Extreme high tick alert.
financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading than that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really
TQQQ is plus 10%. Big move on TQQQ today. Anna came up with the idea this morning. I took it with her. Very nice.
In that range, in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that
High tick alert plus 800. Extreme high tick alert.
At a modestly restricted level at the end of this year, and that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are, and that's what they want to see. Knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this
All right, Bitcoin, looking for a follow through as well.
That's what we did.
Extreme high tick alert.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use.
Leisman. Leisman.
The committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, and the futures market at 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at,
All right, take some profits off in the strength. A lot of people are taking profits here.
Asset prices, credit all of those things go into that. You can also look at the yield curve and ask all along the yield curve where is the policy rate. So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions?
I don't know. I think Jay Powell's pretty good. He does talk too much.
We'd like to see, demand.
Chewy.
Demand is very hot still in the economy. We'd like to see
Chewy looking for a follow through.
better balance between supply and demand. And that can happen.
AERC about to go again. AERC about to go again.
Substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be things the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still pushing upward on inflation. So that's really how I would think about it. I think it's certainly in the range of plausible numbers. I think we'll know when we get there. Really, honestly, that would be, you would have positive real rates. I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days.
We got to get above the high of the day here. Above 38.50. Frankly, I didn't think we'd be above 380, but we are. So if we manage to close above 380, 381, that'd be great. AERC, ABCD pattern trading right now.
Expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data. But I'm wondering on the
AERC is still very strong.
Is there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at
Hi, took alert plus 800.
Looks like we're going to go some more.
So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. I think if you look across that broad range of data, what you see is that expectations are still very much in the place where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the
low ticker minus 800.
Expectations at the board
Extreme low ticker
being pretty flat for a long time. So we're watching that, and we're thinking.
All right, we ran into supply. Head first into supply.
One of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI rating.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're I think as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool?
Looking for a higher low.
And should we think
We keep banging up against 3850.
if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance, and so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of
Low tick alert minus 800.
with us having really just done very little in the way of raising interest rates. Financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that our
Extreme low tick alert.
Any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause. Even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point. And we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late in during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, one or two times. So I don't think it's something that'll come.
AERC is trying to break higher.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
So the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we like to see inflation headed down. So, and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works out like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing. We're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done, because we saw last year inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation
Low tick alert minus 800.
Flexible.
Extreme low tick alert.
Are you more concerned now that to bring down inflation it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SCP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't. The monetary policy stance doesn't affect those things. So, but having said that, there's a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand. For example, in the labor market, so you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to levels. People are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that can work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be
Hi, took alert plus 800.
Again, it's our objective, but as I mentioned, it's going to depend on some external factors we don't control.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate
Extreme high
to
tick alert.
2024. Is a higher unemployment
Extreme
rate
high tick.
necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to 4. The median is 4.1%. Of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment went up to 4.1%, that's still historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We've seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1%
Extreme high tick alert.
Inflation well on its way to 2%. I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome. We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. Where workers are getting wage increases, maybe the workers at the lower end of the spectrum are getting the biggest wage increases as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell, Matthew Bosa with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate in the SEPs over the next couple of years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means that FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. The SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market.
Yeah, algos are listening to everything he's saying.
And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
Given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear. What you're seeing is the situation getting more difficult. And you look around the world. I mean, lots of countries are looking at inflation of 10%, and it's largely due to commodities prices. But all over the world, you are seeing these effects, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really. And by the way, headline inflation is important for expectations. The public's expectations. Why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? Have no reason to. So that's expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today. Hence our resolution to get rates up.
Hi, Tickler plus 800.
To where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you,
Extreme high ticket.
they're going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're of course watching very, very carefully for that, and looking at the retail sales, the big store numbers, and all that kind of thing. And so, I think the fair summary of what we see is you see continuing shifts in consumption. You see some things getting the sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but
Extreme high
still
tickle
at
alert.
robust levels. We see the economy slowing a bit, but still growth levels and healthy growth levels.
So then as we are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit. We're responsible for watching everything, but consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Mike McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations?
All right, looking for VIX to drop off a bit more.
For a headline rate, if the core rate is
Tesla, it's up 32 off the best levels of the session. Tesla.
Responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate.
Chewy looking for a pop above 30. Chewy, that's the high of the day, 30.
Core inflation, because it's a much better predictor. It's much better predictor of where inflation is going. It's also more relevant to our tools.
Clovis trying to get back above 1.
Mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect really. I mean, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices.
VIX looks like it might want to roll over and drop off, lower high.
High tickle alert plus 800.
So it's a very difficult situation to be in, and we can't do much about the difference between the elements that make up headline that are not in core.
Extreme high tickle alert.
On the SEP, when the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point?
All right, Bookmap is showing supply is rolling up a bit higher. Okay, we tested 38, 36, 38, 37. Now supply is moving up. 52,000 contracts moving up from 38, 37 up to 38, 50.
It's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
Hi, Victoria Guida from Politico.
Extreme high tickle alert.
How you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good.
All right, this is just the same stuff over and over and over. All right, I apologize for that. I needed to hear what they were saying. Powell was saying because algos are listening. They're listening to every word that comes out of his mouth. So far, price action has said that we could see a test of the highs again or a test of the lows. All right, VIX is trying to hold here.
Low tickle alert minus 800. extreme low tick alert. Low tick alert minus 800.
right, so waiting for Jay Powell to stop speaking. VIX is near the lows of the FOMC announcement. We were a bit lower earlier. Supply is still up there at 38.50. All right. TQQQQ looks like it wants to go. Let's see the FANG stocks. Algo flow continues to be more bullish. Price fading a little bit here over the last half an hour or so, 45 minutes. But algo flow continues to rise, and we have SPY algo flow, and calls are outpacing puts. Event risk is dropping off. TQQQ looking for more follow through. TQQQ looks like it wants to keep going.
Hi, took alert plus 800. Extreme high took alert. Extreme high took alert.
Okay, VIX dropping off, making about to make new lows here. VIX, TQQQ.
High took alert plus 800.
All right, we're starting to
Extreme
rally.
high took alert. Extreme high took alert.
All right, so we're pushing the highs. All right, I bought some TQQQ calls about 6 minutes ago.
Extreme high took alert.
All right, get above 38.50. EWZ looking good. EWZ, the Brazil ETF. Nice bounce, EWZ. EWZ.
Extreme high took alert.
All right, 38.50. Watching for supply to either evaporate, hold steadfast, or roll up. Got about 100,000 contracts overhead. Above 38.50, this sucker could rip.
High took alert plus 800. Extreme high took alert.
All right, we're taking out the high of the day. We're going to take out the high.
Extreme high tick alert.
Love it. All right, there goes futures.
Extreme high tick alert.
All right, supply is evaporating a bit. It's still there, but if we get above 38.50, we could run a bit higher. Okay, so not a bad day, not a bad evening. Not a bad evening. I'd like to see maybe take some profits off the table here. Let me see what I want to take some profits off on. Alibaba just shy of the high of the day. Tesla near the high of the day, above 700 a few minutes ago. Amazon near the highs of the day. Chewy going for the highs of the day. AERC is up 42%. Twitter, Clovis still going.
High tick alert plus 800.
Yeah, I was just going to post that, Frank. You beat me to it. All right, there goes the futures taking out the high of the day. 38.50. Aggressive buyers here. I imagine a lot of people are short. Probably some pissed off bears right now. All right, there we go. Okay, nice going here. Everything's getting bought up. Goodbye. All right, supply is gone, folks.
Extreme high tick alert. High took alert plus 800.
Supply is gone, folks. You can yell at the markets. You can tell it to do something that it's not going to do. But as we took out supply just now, that told you what's going on right now. Deltas are still rising. We still have a chance to reverse all of this. So do take some profits off into strength. Don't be silly. Just because we've got an hour worth of, we got an hour and a half worth of rally under our belt doesn't mean we can't pull back. All right, I'm out the calls, the TQQQ. Could keep going. Could keep going. I made 50 cents. That's all I wanted. I want more, but you understand. All right, algo and SPY call flow is showing profit taking. I would do that.
Low tick alert minus 800. Extreme low tick alert.
Okay, so VIX bouncing a bit. All right, let's see what TNX looks like. 10-year yield. TNX. Okay, backing off a bit. 10-year yield, just trading inside day. Okay, so rule of thumb on an inside day. Okay, rule of thumb on an inside day. I don't talk about this much, but inside day, if that remains a doji by the end of the day, I'd be long on a move higher and short on a move lower underneath this doji. Okay, so if that's, can find some other dojis, we'll give some other examples. That's what I would trade for now. Looks like we could consolidate. A lot of the event risk is coming off. People taking profits. Calls are starting to fade a bit. I would do the same.
Extreme low, tick alert.
All right, people taking
Low, tick
profits.
alert, minus
You should be
800.
doing the same. You should be doing the same. Tesla off the best levels of the session, above 705 a few minutes ago. 8 minutes ago, we were right at 705, making higher highs, higher lows. Tesla could continue. We tapped 704.97. Alibaba, still looking for a follow through. Alibaba. All right, so VIX chopping around, so opportunities to, I'm going to leave those cover calls alone for now. So far,
Low, tick alert, minus 800.
so far, doing well.
Extreme low, tick alert. Low, tick alert, minus 800. Extreme low, tick alert.
All right, UVIX bouncing again. UVIX bouncing again. I'm just going to keep repeating this trade over and over and over. I can't wait. I can't wait to get my cost basis down below $10. And I keep this trade on. I'm plus 6 right now on the position as I keep bringing that cost basis down. And I keep the hedge on. That's the beauty of it. The beauty is I keep the hedge and I'm making money at the same time. So if the markets go to hell in a handbasket, UVIX or VIX pops to 40, I roll the calls out again, and I just keep doing this over and over while keeping this hedge on. I also have QID. I didn't sell cover calls on QID because I'm too busy on UVIX. Also have TWM, the short on small caps. No, RWM, sorry. RWM. This has actually been kind of fun. It looks like we're going to make a higher high now. Looks like VIX wants to make a lower high. Still pushing up a little bit. There's still a little supply coming back in at 38.50.
Minus 800. High took alert plus 800. Low tick alert minus 800.
All right. So, unless we fall apart into the close, which is entirely possible, we're up $5 on SPY, 1.39%. We've had a horrific week. So, bulls don't get too celebratory. 90 minutes or 2 hours of a rally does not make a reversal. Okay, we got 3 candles here, a low, lower low, higher low, but we still need to maintain this bullish look to this candle. So some of you are positioned looking for more downside before making any kind of substantial move back to 9 and 21 day. We're still in a downtrend. So please, if you are a perma bull, please hedge. Please hedge when these hedges that we've been using, like QID, when they get down to the lows like this, when they pull back, you know, scale into a little bit. And UVIX, same thing. Scale in a little bit. You might get a little bit lower cost basis on UVIX, but I don't think this is over in a big way. I don't think this is over. I think this. I don't think I'm saying anything that you guys don't already know, and ladies. But this downtrend has been horrific. You know, 11% in 6 days. Okay, Black Monday, 1987, Black Monday, that was a 23% drop in 1 day. Imagine a 23% drop in 1 day. I remember standing near the water cooler. Everybody was like freaking out. People that had been working, you know. I had just gotten out of college. I remember people standing there like all freaked out because their 401ks and whatever they were trading were damaged in 3 days. 36%, something like that. 33% in 3 days. 23% on Black Monday. And but the funny thing is, if there is a funny thing to it, eventually the markets will find institutions. They'll find value. All right. I'm still thinking there's downside. Okay. Substantial downside. I'll just leave it at that. So if we do bounce, and I'm hoping we do, that'll give us a chance to reload at a higher price.
Hi, took alert plus 800.
All right, so today was a pretty slow week for earnings.
Low tick alert -800.
All right, so the middle of July is when we start to see the banks, the week of the 13th, the week of the 11th. Bank of Canada hiking 75 basis points at July meeting. Bank of Canada hiking 75 basis points at July meeting. All right, Goldman Sachs. Whoops. All right, looking for a higher low. Looking for a higher low. All right, still on a downtrend. We really need to close this in the upper half of the daily range if you're bullish. Wow, that snuck up on me. I was completely oblivious that the close was that near. All right, that's a closing print. That is the closing print. All right, so stocks are up on the day. I have TQQQ shares left. I'll swing those till tomorrow. Sold some covered calls. Sold some covered calls at the high. Also had calls that I took off into that ramp above 25.80. I had a nice profit there, 50 cents. I was looking for more, but I was okay with 50 cents. As you know, I've been trading around UVIX. Got my cost basis down to 1250. Once I close this last trade, this is like the 8th trade I've taken in the last 3 weeks. Once I close this trade, it should bring me down below 12 per share on UVIX. Okay, if I can get 50 cents to $1, maybe I can get it down to 11.75 or so. Okay, it's been a very effective trade while holding on to insurance. So this goes into the memory bank as something to do. Next time we have a 6-month downtrend. I could have been trading, well, UVIX didn't start trading until, what about 2 months ago? Let's see. Okay, UVIX started in April, late March, April. So it's only been trading for 2.5 months, UVIX. I had the desire to see how it trades versus the VIX. It says it's 2 times. It's not always 2 times, but they endeavor, I guess, during these ETFs have to change their investments. They usually do that after 2 o'clock. Rebalance, do whatever they have to do. So sometimes it's 2 times. Most of the time it's 2 times, but a lot of times it'll move closer to what VIX is doing. Anyway, this has been a nice experiment over the last 3 weeks, 4 weeks, and something to remember for everyone. Next time we get to a point where the S&P looks like it's going to top, okay, so it'll be around then. Okay, so we got that top. I missed all of it. So we had all of this over here on the right, May and June. April, May, June. Anyway, I'm very happy with that trade. And we still have the protection, which is the best part of it. And we're getting paid to hold insurance. That's probably the best thing about it. Anyway, I hope everyone had a good day today. It was kind of fun after the Fed. I got moves all over the place. I hope you guys had a good day. Thanks for everything. Thanks for all the good ideas. Thanks, Anna, for the TQQQ idea earlier. Among other things, a lot of great trades and ideas posted in the trading room, your trading room. So whenever you're posting something and it works, you're helping out your fellow members. And you're also helping out yours truly, because I cannot possibly watch anything more than I'm already watching. I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 screens that I'm watching. And that's about it. That's a wrap. So into the close, we see calls from SPY, the Qs, Apple, Uber, Tesla, Coin. I'll repeat this. Meta, PayPal, Tesla, Carvana, the 30 calls, Microsoft, Amazon, Tesla, lots of Tesla calls, Square, FXI, Alibaba. Alibaba, I see the 95 calls for next week, for next Friday. There was 200 contracts there. Into the close, the algo flow faded off as people were taking profits off, pretty much doing what we're doing. Scalps and day trades. The supply that was at 38.50 is pretty much gone now. That fade we also saw in deltas on the futures into the close, same as the, if you're watching Tradie Ticks, same as the option flow summary. Faded about 45 minutes ago and just kept fading SPY calls still outnumbering SPY puts. Okay, the strongest sectors today, consumer discretionary, hands down. Communications, services, technology, real estate, financials, healthcare, and industrials. Losing sectors, materials, utilities, consumer staples, energy. All of the defensive sectors, not as favored today. Okay, that does it for me. Take care. Have a great evening. Ciao. That's a wrap.